So shall we begin with the session?
Okay, madam. Shall I start now?
Yes.
Okay.
Good afternoon, everyone. I welcome you all on the behalf of ICSI IIP. And for our second session today, which is on the topic of contingent liabilities under the code, we have Siva Rama Prasad sir with us to deliver and conduct this session. Sir is a qualified professional in cost accountancy, company secretary, finance, commerce, with over 36 years of rich experience in banking and finance service, with cross-cultural experience and good knowledge in insurance sector. Sir has handled various senior level responsible positions with higher level interaction and exposure. He has also authored numerous books and study material for the professional institute like ICSI, ICAI, ICMA, and other Insurance Institute of India, etc. Sir, you are most welcome to our session and you may please begin.
Okay. Thank you very much, madam. And my voice is audible, madam.
Yes, sir, it's audible and your PPT.
And the PPT is visible and moving also.
Yes, it's
Okay. Thank you very much.
yes.
First of all, thanks to ICSI, Insolvency Professional Organization, for giving an opportunity to discuss about the treatment of contingent liabilities under IBC by the IP. But the contingent liabilities, everybody knows about that one. It is not an exact liability. It is a probable or possible liability in the future. That's why, as per accounting standards, it is to be mentioned at the footnote of the balance sheet. That is the brief definition of the contingent liabilities. But whether to be included in the claims or not, whether he is a part of the COC or not, all these things, it is very, very easy. But what are the various contingent liabilities that are there in the business organizations? That we have to see. Take, for example, banks are providing two types of products to all the corporates. I will discuss about the contingent liabilities, because to include or not, our decisions are based on that particular the type of the contingent liabilities, etc. But we should have the full knowledge or grip about the contingent liabilities. Banks are providing two types of products. All products are banks products or financial products only, whether it is a housing or education or corporate loans, working capital or term loan, all are classified into two categories. One is a fund-based, second one is non-fund-based. Fund-based means immediately the amount is provided to the prospective borrower. The bank is giving money. But a non-fund-based fund is not providing any money. They are giving only the guarantees or letters of credit. But bank also giving only simple paper on stamped paper. They are giving guarantee on behalf of the borrower to the beneficiary. Here three parties are there: the issuing bank, the applicant who is applied for the guarantee, and the beneficiary, the person who is taking that particular guarantee, that is called the beneficiary. These three people are there. This is called fund-based business, a non-fund-based business. In the non-fund-based business or fund-based business, banks are following the credit management guidelines in total. Take, for example, I am the contractor company, that is infrastructure company. And the government asked me to construct the 4 lanes road for 10 kilometers. Then once I applied for the tender and I won the tender also, then government will ask the guarantee. That is called a performance guarantee. That road should be completed, that 10 kilometers of 4 lanes road to be completed within 6 months. If that is not happening, whatever the loss incurred to the government, that is to be paid by the contractor company. Then the government will ask some guarantee in favor of the government, and normally the contractor company has to pay the amount that is a fixed deposit. Whatever the loss to be incurred by the government, that is to be paid by money to the government. But the government will also give some option. Okay, instead of paying the money upfront, I will accept the guarantee from the reputed financial institutions that are registered with a particularly license given by the Reserve Bank of India. So here, the reputed banks, they will issue the guarantee. First of all, for this also, they will do the appraisal process, whether he is a A1 contractor or not, and how much guarantee is required. And the guarantee also, particularly the period of guarantee, what is the claim period, what is the total period, and how much cash margin he will bring, all are stipulated by the bank. For guarantee, not simple, even though it is a simple paper on behalf of the borrower, the bank is giving to the beneficiary, but some conditions are there. Suppose 100 crores guarantee. For that 25% cash margin, the borrower has to deposit with the bank by way of a fixed deposit. And 75% worth of a collateral security, either building or land, whatever it is there, the collateral security to be given by the corporate to the bank. Then only the bank will issue the guarantee. So this is called a non-fund based business. For that, whatever the guarantee period is there or claim period is there, for both the bank will take a commission. But if at all he constructed that guarantee, a particular road, 10 kilometers, 4 lanes, nothing will happen to the bank, because whatever the original guarantee given to the government, the borrower will bring back to the bank, and whatever the margin money, 25%, whatever the collateral security offered to the bank, all will be returned to the particular person. But sometimes that is not happening. That is not happening means, not happen means when immediately the borrower is not constructed the road within 6 months given by the government. Then the bank, the government will invoke the bank guarantee. No, the borrower is not adhered the terms and conditions of the guarantee. So please pay the amount, and immediately once they send to the guarantee form, original guarantee issued by the bank, back to the bank branch, the branch will open an account, loan account, and debited that total amount to the loan account, and give the demand draft or directly through RTGS, that amount will be credited to the state government. This is the process. From the day one, it is debited to the loan account. The interest will be charged by the bank as per the original terms of the contract. That's why the guarantees, once it is a maturity is completed without any problem, then automatically we will return back the amount the 25% cash margin and 75% collateral to the borrower. Once that is not happened, and the borrower is not completed that contract within the scheduled time, then the government will invoke that particular guarantee, and they will they send that guarantee form to the bank and ask the bank to pay the amount. Then the bank will open the account in the name of the borrower or in the name of the company, particular company, debited the total amount to be paid to the particular state government, and credit to the state government, and inform to the borrower to pay the amount immediately. Once he is not paid or adhered, whatever the cash margin is there, the cash margin 25% they will credit to the loan account, and either through SURFACE or DRT or whatever the other modes are there, all they will use to recover that amount of the 75%. Normally, this 25% is not for all people. Banks will insist 100% cash margin money for the non-borrowing borrowers, and for borrowers based on the history and based on the relationship with the bank, they will reduce either 50% collateral, 50% cash margin, or 60% collateral, 40% cash margin, or 25% cash margin and 75% collateral. Like that, it will differ to bank to bank based on the credit policy guidelines of the bank. Once the loan is created, then the bank will charge interest from that day onwards till the bank guarantee amount is to be paid by the borrower. This is a non-fund based business. Today in the banking industry, when compared to fund based business, non-fund based business are huge. Even corporates, particularly the corporates like infrastructure companies, export-import corporates, deferred payment guarantee for exports and imports of capital goods, power projects, oil companies, and the companies located in special economic zones or information technology companies, etc., etc. They used to take the guarantees more or letters of credit more when compared to the fund-based business. Even this discounting facility is also there. That also I will discuss later on. Today's topic is not the cases and other things. First, understand the full concept of the contingent liabilities. Then whether the claim or debt to be admitted or not, that is a secondary issue. That is a simple issue. Whether it is to be mentioned in the information memoranda, or whether if the claim, if it is a debt, whether that financial creditor to be admitted in COC, all these things are simple issues. But the issue main is what is the contingent liability? What are the various types of contingent liability? What is the process of the contingent liability? What is the accounting standards of the contingent liability? And how it is to be valued? All these things are important when compared to the case studies and other things are. That is simple task. Simple task. So if you take as a banker, particularly corporate accounts group branches of my bank, that is State Bank of India, we use it to give number of guarantees. Daily, today, the upfront amount, nobody is paying cash payment, down payment, and they are not taking. Take for example, DPG guarantees are there. If any cement factory is there, or power project is there, the machinery to be imported from other country, the seller is required DPG. Because banks are not giving that much loan to the power projects for DG sets and cement factory. But the supplier, he will give the loan on some installments for a period of 3 years or 5 years. For that, for each installment, the borrower has to pay. If not paid, the amount to be paid by the banker, that is called deferred payment guarantees. The DPG guarantees are also more. But guarantees means it is as good as a fund based only. But here, at the time of issuing the guarantee, funds are not, outflow is not there. But later on, depending upon the situation, may or may not arise the funds position. That's why it is called contingent liability. For contingent liabilities also, banks are not, is a secured creditor. Why he is a secured creditor? Because 25% cash margin is taking, 75% collateral security is taking, and the revenue to the bank is not interest, it is a commission. In the bank balance sheet also, the contingent liabilities are mentioned in the footnote of the balance sheet. Like the corporates who are enjoying the contingent liabilities, they are also mentioning in the footnote of the balance sheet. Contingent liabilities, the concept, the recognition. So whatever the syllabus, whatever the initiator told, accordingly I developed the PPT. I want to disseminate the information to you. In business organization, there are many transactions that occur. Final outcome is not always known at a time. At the time, final outcome, in case of a bank guarantee, final outcome will happen after certain time. If at all the road is constructed, no problem. If at all not constructed, then only the problem will arise to the bank. And some such incidents involve litigation, insurance claims, pending disputes. Even contingent liabilities, and not only the bank guarantees and a letter of credit and the bills discount, litigations. One property is a corporate property, but that corporate told that property belongs to me. But the agriculture store, no, we have not sold that property. They have taken away that property. Now they filed a suit in the court, litigations. If at all the company succeed, the property becomes the owner of the property will be the corporate. Otherwise, the owner of the corporate is the original landholders. Insurance claims. As per insurance policy, if any eventualities are happening, either fire or theft or burglary or particularly marine policies. Once the goods are transferred from they transported from through ships, the shipping authority will give the bill of lading. And during that transit, some sea perils or at the time of a destination, the government policy. For all these things, insurance policies are covered by ECGC, Export Credit Guarantee Corporation, or the general insurance companies also. But here, once any damage happened, then sometimes a full amount may not be reimbursed by the claim is not paid by the insurance company. If at all any disputes are there, again the company will approach the courts to recover the balance amount. So that insurance claims also contingent liabilities are there, pending disputes. All these things are come. Take for example, workman compensation. So suddenly the accident was happened in the factory premises, production department, but it is a negligence of the worker. But management not paid that compensation. Then automatically the workers union will approach the labor courts or the management will also consider. So all these things are the contingent liabilities. Any liability arising such a situation are known as contingent liability. Contingent liability not restricted to the bank guarantees and letters of credit, but the major portion is the letters of credit as well as bank guarantees. Contingent liability. A contingent liability is may or may not happen. The contractor, as I told, if at all he completed, then there is no problem. Sometimes if at all is not completed, then it is an obligation to the bank to pay the amount to the government. This means uncertainty about the record. The future, sometimes it is predictable, sometimes it is may not be predictable. Such liabilities in a financial account. Uncertainty, once uncertainty is there, it is not accounted for in the financial statements. That's why we are putting in the below balance sheet as a contingent liability. So here uncertainty is there. If a certainty is there, it will occupy the space in the financial statements. This is because of happening or not happening of the contingent liability is not in the hands of the business organization. Suppose a court case is there, based on the views of the both the people, then the judgment will be given by the judge. Till such a time, it is very difficult to predict that one, whether we will win or he will win like that. There are two types of contingent liabilities can be defined. One is a past event and another is a future event. So two ways the contingent liability can be defined. One is a past event and another is a future event. Based on the future event or past event, contingent liabilities will arise. It is an obligation that may be possible arise on the occurrence of non-occurrence of a certain future event. The company has no control of the said event, contingent liability. An obligation may arise in the company for past events also. Some past events, sometimes obligation may arise. This happens, it is not likely outflow funds. So it is once an obligation may arise from the past events also. This happens when it is not likely the outflow funds will be required to discharge the contingent liabilities. Sometimes the outflow funds may not arise. Sometimes outflow funds will realize. No reliable estimate can be made for legal obligation. It is very difficult to estimate the contingent liabilities. Thereby, there is no prior preference for the company to make such estimates. Contingent liabilities valuation or estimation is also depends upon so many parameters and factors. That also I will discuss. Recording of the contingent liabilities in the financial statements, how these are recorded. One thing is clear, contingent liabilities never recorded in the financial. It is not having the space in the balance sheet. Not space, no space. These obligations have not occurred yet, but there is a possibility of the occurring in the future. So the contingent liabilities no accounting treatment. All our accounting standards are there. For accounting standards, some system is designed. According to that design only, we have to prepare the financial statement. But in case of contingent liabilities, contingent is never recorded in the financial. That's why it is a footnote of the balance sheet. However, considering the business organization follow conservative approach to the accounting system and follow the practice disclosure. So the contingent liability is a contingent, like a contingent asset will be disclosed in the financial at the foot. Like a contingent liabilities, contingent assets are also there. That also I will discuss. So both the contingent liabilities as well as contingent assets are to be mentioned at the foot, not in the record, not to be recorded in the financial statement. Only this is to be mentioned in the footnote of the balance sheet. This will happen if there must be a possible of a present obligation from the past event. Based on the history, this may be an obligation. The outflow of economic resources to settle the obligation is not probable, only possible. Such a possibility, if happens, outflow of the resource not remote. Once that is a possibility is there, the amount to be outflow is a remote chances. The amount of obligation can be reasonably measured. That's why for contingent liabilities also, the corporates are providing provisions. Contingent liabilities has to be reviewed yearly basis, not Q1 or Q2 or Q3 or Q4. Every year it will be reviewed. What is the present status? Whether we will win or they will win. Whether the contract, suppose the contract is going to be completed within 1 or 2 days, then I need not mention about that one. The accountant, management, or auditors, etc., must take decision based on the information they have, whether still it is a contingent liability or if now a provision or even liability, whether it requires a provision or as it is a contingent liability or not, that is to be decided by the board of directors or accountant or management. Take for example, a company gave the bank guarantee on behalf of the subsidiary. They have given one bank guarantee because the subsidiary is availed some loan with the commercial bank. For that loan, the company has given bank guarantee. For the past 3 years, this has been shown as a contingent liability because the subsidiary is also functioning very well and the problem not arise. This guarantee is till the loan is to be closed by the subsidiary. Now the current financial year, the subsidiary company went into the financial crisis and is almost verge of bankruptcy. Then the obligation arises to the parent company. Then such case, no more contingent liability. That is to be paid by the parent because they have given the guarantee to the bank. If that company is failed, I am ready to pay. Now the company must consider this as a provision or even liability and pass the necessary accounting entries to recognize this. So here, the company must consider this as a provision or even liability for the passing necessary accounting entries to recognize the same. Contingent liability and provisions. There is a difference for contingent liabilities also provisions are to be made. A provision is a liability which can only measure the significant degree of estimation. How much probable loss will happen on account of that particular guarantee. Suppose a subsidiary company they have given and it is a verge of bankruptcy. Definitely the burden or the responsibility to be happen on the parent company. For that estimation of loss, the amount to be paid, that is to be provided as a provision by the parent company. This means that obligation is already present, but we cannot determine the exact amount of the obligation. Only estimates can be determined. In contingent liabilities, estimates only will happen. Then in such case, we can make the provision for such liability. For such liability. The contingent liability provisions are to be recorded in the books of accounts. And the debit to profit and loss account provision and some examples of provision for bad debts, provision for taxation. So once, suppose I have filed, I have paid the corporate tax some amount, but income tax authorities are not agreed for that amount. They are asking higher amount and they issued the demand notice also. And I have contested in the court. So once it is in favor of that particular income tax, I have to pay the amount. I have to provide the provision by debiting to profit and loss account. And through that provisions only, I have to pay that amount. Sir, somebody has not put in mute condition, sir. With some examples of provision of bad debts. Bad debts also, every year, the company is providing bad debts provision. That is a bad debts provision is also there. Out of the debtors, some even banks are also non-performing assets provision for substandard, doubtful assets 1 year or 2 years or 3 years or loss assets, banks are providing provision. In the similar manner, these are also provisions are required some contingent liabilities also. There is only one scenario where the provision will not be recorded. Sometimes for contingency provisions are not in the books of account. If the liability is probable, more likely than not, but cannot be measured or estimated with any reliability, or such liability can be considered as a contingent liability. So if in one scenario, the provision is not required, that provision, particularly estimate liability, cannot be recorded in the books of account. It simply cannot be measured. Such instance are very rare case in the normally in the business organization. Normally, it will happen in the business organization. Now, if you refer, they compare the provisions and contingent liabilities. Provisions are present obligations. Shortly, it will happen. I have to pay the liabilities, but with an uncertain amount. If a certainty is there, it is not a provision. The amounts can only be measured with a substantial estimation. Provision, bad and doubtful debts. Some of the data more than 180 days. It is a remote chances to recover. The whereabouts of the debtors are also not known. In that case, we have to provide the provision. Even banks also, they are providing provision 20% or 50%, depending upon the period, they will provide the provision. But whereas in contingent liability, possible obligations, here present obligation, this is a possible obligation. So they may not actually occur. It will depend upon the occurrence and the non-occurrence of the certain events over which the company has no control over it. That is called contingent. But in case of provisions, provisions are meet recognition criteria. This means they are recognized in the books of as per accounting standards. Whenever the bad debts are going to be happen, for that the company has to provide the provision. But whereas in contingent liability, on the other hand, are only disclosed in the notes. Notes means the footnote of the balance sheet, the notes to be mentioned to the accounts, because they do not meet the criteria. If the management estimates the liability is probable, that settlement of the obligation will most likely result an outflow of economic resource, and it will recognize it as a provision. Suppose one court dispute is there, labor court, and the court is going to be awarded that in favor of the workers, this much compensation to be paid by the company. Then automatically that amount to be provided in the books, and this is an outflow of economic resources to the company, because the company has to pay the amount based on the court's verdict. If the management thinks that the chances of economic outflow are possible but not very likely, then these are to be treated as a contingent liability. Chances of economic, the management thinks that chances of economics are possible. Probable, you have to provide provision. Possible, you have to show it as a contingent liability. Possible, probable. Probable means you have to provide the provision. Possible means you have to mention this one. Take for example, one small information. A company is facing litigation. The lawyers informed that there is a chance of 70% that the company will not have paid damages. 70% chances the company will not have pay any damages. And 30% possibility for damages arising. How should the management recognize that liability? The possibility of the actual outflow of economic resources are meet a possible obligation of 30%. So while such obligation arise is possible, it is not probable. So the company recognizes contingent liability and disclose it in their notes. No accounting entries are to be posted. So here 70% need not be paid, but 30% is there. So that's why the company has to recognize it as a contingent liability because the possibility is there. Contingent liability is a potential asset. So far, I have discussed about the contingent liability. Now I am discussing about the contingent assets. Both are there because these two types of transactions also number of companies it will be there. So whenever these two types of the liability and accounts, liability and assets are there, how to account for first if we know the basic features of this two types of the asset or liabilities, then after that whether to include or not include in the list of claims or the voting rights, all these things are separate matter. But we have to have the full grip on the contingent liabilities and assets of the company, the various types. The contingent asset is a potential asset or economic benefit of the company. It does not currently exist, but may arise in near future. The occurrence of such contingent asset depends upon the occurrence or non-occurrence of a particular set of events which the company itself does not have full control. Such asset or economic interest arise from an uncertain and unpredictable event. For example, if a company is locked in a legal dispute and has a possibility of winning the case, being entitled to claim or damages, then it is called a contingent. Suppose some assets are there, disputes are there. That assets company is claiming, at the same time the others are also claiming. If the company is won, definitely it will become the asset of the company. At such a time, it is to be mentioned as contingent asset only. Due to uncertainty in accordance with some accounting concepts, contingent assets do not find in the balance sheet of the company. The reasons are contingent asset is not recognized as an asset. Till such time, it is not recognized as an asset because uncertainty event is there. What is that uncertainty? The occurrence of such benefit is not given. Since the outcome of the event is not fully controlled by the company and cannot guarantee its occurrence, there may the case of we might recognize the contingent asset never realizes. Hence, the keep of the balance sheet of the company, particularly the contingent asset also. Conservatism policy, accounting principles. The conservatism principle is a clearly stated, uncertain future expenses must not recognized immediately. But the future uncertain income must not be recognized. Future expenditure, whatever uncertain future expenditure, that is to be recognized, but the future uncertain income not recognized as per the accounting principles. A contingent asset will come under this later. The idea behind the principle was to record the lowest possible profit in spirit of the trueness and fairness of the financial state. So whatever the probable expenditure is there, we are accounting for. Whatever the probable income is there, we are not accounting for. What is the reason? The idea behind the principles to record the lowest possible profit in spirit of true and fairness of the financial. On that objective only, we are not recognizing this the future uncertainty incomes. Disclosure of the contingent asset. International Accounting Standard, IAS 37. In some course, they referred that accounting standard in the International Accounting Standard 37 outlines the treatment of the contingent liabilities as well as contingent assets. Even Supreme Court also, in one case, they referred the International Accounting Standard 37. So the contingent liabilities or contingent assets outlines the treatment outlines are defined under IAS 37. In the similar manner, the Institute of Chartered Accountants also published Accounting Standard 29 to deal with the same. So the accounting standard of our country, that is Institute of Chartered Accountants of India, that is AS 29, and International Accounting Standard 37 recognize the treatment of both the contingent liability as well as contingent asset. What is the asset? AS 29 state the contingent asset should not be disclosed in the financial statement due to the following accounting concept of the prudence. However, approving authority can make a mention in the asset in their report. But even though it is not recognized as a item in the financial statement, but this is to be mentioned in the financial report, financial accounts below the balance sheet. In this case, company will be reported by the board of directors, but the disclosure can be made report only if economic benefit is possible. That is more likely to happen. Then only that is to be mentioned. Then only that is to be mentioned as a contingent asset. The amount of such asset benefit can be estimated reliably. So even contingent asset also, if you are going to mention in the balance sheet, then the probable likely or more likely to happen, that only those items are to be mentioned in the footnote of the balance sheet, and the amount of such benefit can be estimated reliably. Contingents are monitored very closely because it is not reflected in the financial statement. If it all reflected, then there is no problem. But these contingent liabilities, if it are not reflected in the below the balance sheet, then automatically it is as good as a window dressing to the particular prospective, the shareholders or investors, whoever is there. Once it becomes certain, economic value will arise. Only then they can be included in the financial statement. This asset is not a contingent asset no more. Once it becomes certain, then it will not treat it as a contingent asset. A court order, XYZ company must pay ABC 25,000 in damages to ABC company. Has not yet received the money. It can be recognized as a contingent asset as an asset now. Yes, now the contingent asset becomes the asset. Although the payment is not received, the court ordered the payment, so the income has virtually certain and now can be recognized as a. So till the judgment comes, it is to be mentioned. But once it is finalized, decreed, then we can recognize it as a asset also. Now, understanding the contingent liabilities. The contingent liabilities are guarantees and counter guarantees given by the company. Whenever the guarantees or counter guarantees are given by the company, it is called as a contingent liability. Guarantees that a company given to the other person on behalf of the third party, that is also contingent liability. Product warranties, that is also contingent liability. Shareholders guarantee, that is also contingent liability. Letter of credit issue, that is contingent liability. Potential adverse judgment case regarding financial dispute, all are contingent liabilities. So in this contingent liability, prominent items that in the CIRP arise only in case of two products, two contingent liability, the liability products. That is, one is bank guarantee. Second one is a letter of credit. We will discuss about that two concepts in detail. After that, valuation. After that, how it is to be recognized in claims, and whether voting right is required or not. All these things one by one, we will discuss. Now, I am going to discuss in detail about the bank guarantee, in detail about the letter of credit. Sir, any doubts up to this point of time, sir? Madam, any doubts up to this point of time? It is a general. Why it is a general means the concept clarity is required, particularly the contingent liabilities. We are dealing with the liabilities, we are dealing with the assets in CARP process. But today's corporate world, particularly, they are using more on bank guarantees and letters of credit. Not only the bank guarantees and the letters of credit, some contingent liabilities are also there. So that also to be factorized in the list of claims, If it are we completely ignored, later on it will create a problem to the resolution, prospective resolution applicant. Any doubts, sir, up to this point of time? Sir.
No, sir, it's clear.
Sir, madam?
No doubts, sir. It is very
okay. Okay, madam. So now I will discuss about the bank guarantees, letter of credit. Because here, if you see the balance sheet, below the balance sheet, when compared to the loan taken from the bank, 3 or 4 times bank guarantees, 3 or 4 times letters of credit, letter of credit is there. Letter of credit or bank guarantee much more than the working capital loans or term loans. Today, term loans are also not given by the banks, particularly the corporates, big, large corporates. The corporates are enjoying the DPG, deferred payment guarantees. These guarantees and the letter of credit in detail, I will discuss. I will discuss in detail. Types of bank guarantees. Types of bank guarantees. If you see in the balance sheet, under the liability side, working capital, that is cash credit or bank loan, term loan, or whatever the other liabilities like debentures, bonds, and other things are there. But in footnote, this bank guarantees as well as letter of credit, lot of big amounts are there when compared to that one. When compared to that working capital and a term loan. Today, most of the corporates, big corporates, they are using these two products. These two products are called contingent liability products of the company from the banks. Whenever the bank guarantee is given by the bank will assess the requirement of the bank guarantee based on the financial position of the company. They will take margin. Normally for loan margin, 25% is there. That is, if the asset value is 100 rupees, the bank will give 75 rupees and 25% borrower's margin. In the similar manner, in the bank guarantees also, minimum 25, but in extraordinary circumstances, they may reduce for the top client, top borrowers also. But the standard is 25. That is cash margin. What is the cash margin? He has to bring the amount of funds to that extent. If he requires 100 crores guarantee, 25 crores worth of fixed deposits he has to give it to the bank. Remaining 75% is not unsecured. It is a secured, that to collateral security. like buildings or land, etc., etc. For every bank guarantee, two are there. One is cash margin, second one is collateral. Second one is collateral. But different types of bank guarantees are there. And here the appraisal is more or less the credit appraisal. And the banks are following bank guarantees are governed by Indian Contract Act. But whereas the letters of credit are governed by Uniform Customs and Trade Practices for Documentary Credit, that is the International Chamber of Commerce brochure number 600. These are why whenever this type of problems are arised, then you can refer the Contract Act, particularly for bank guarantee, and UCPDC for letter of credit. A bank guarantee is a guarantee from a bank, which the bank will fulfill the obligation of the debtor if the debtor fails to do so. Bank guarantee thus mechanism of a third party performance, due diligence, and accept the responsibility on behalf of the debtor for consideration. Bank guarantee is a part of doing business or required various business transactions, particularly the infrastructure companies. They are using widely one product, that is a bank guarantee. Even pharma companies also. They are widely using the bank guarantee or letters of credit. The bank guarantee is an amount of money to the beneficiary, borrower, issuing bank, beneficiary. So the borrower will approach the bank for bank guarantee in the name of a beneficiary. So the beneficiary will ask the borrower will approach the bank, and the beneficiary will take the guarantee. In case the borrower fulfills the contract, the beneficiary will hand over the bank guarantee to the borrower, and borrower will again hand over the guarantee to the bank and take back whatever the 25% cash margin, whatever the 75% collateral, he will take back. In case the borrower is not fulfilled the contract terms, then the invocation of that particular guarantee will happen. Then the beneficiary will directly send the bank guarantee to the bank that your client, that is a borrower, not adhere the terms and conditions of the bank guarantee, please pay the amount fully. Immediately, without any second thought, by informing to the borrower, bank will create one loan account and pay the amount to the beneficiary. From that day onwards, the loan amount carries rate of interest. And immediately the borrower has to pay the amount to the bank. If bank is not, if the borrower is not paid, first the bank will appropriate the cash margin of 25% to the loan account, remaining 75%, then they will take action by selling that particular secured. It is a secured loan, and whatever the collateral security, the bank will use the surface or whatever the resolution process are there to recover the loan, they will do, and they will close that account. A bank guarantee is an amount of money to a beneficiary if the bank guarantee applicant does not fulfill the conditions of the contract. A bank guarantee is mainly used to ensure buyer or seller from the loss or damage to the non-performance by the other party in the contract. For the non-performance only, then the guarantee is devolved or invocation of the guarantee. Performance. There are different types of guarantees are there. The first one is the performance guarantee. Performance guarantee is used as a collateral in the transaction involving buyer and seller. A performance guarantee typically invoked by the buyer incurs the cost and the seller does not deliver the goods promised in the contract. and the invoke of the performance guarantee, beneficiary requires to declare in writing to the seller did not fulfill or his contract properly or on time. Suppose earlier example, I told about the 10 lines, 10 kilometers, 4 lanes road. For that, the state government asked some guarantee from the bank. And the borrower approached the bank and take the guarantee in favor of the beneficiary, that is the state government. As long as the borrower completed the contract as per the terms of the tender, then there is no problem to the bank or to the borrower. Otherwise, if the government, if the borrower is not adhered the terms of the contract, then the government invoke the guarantee and they will send the bank guarantee to the bank and ask them to remit the whatever the loss amount is there. Immediately the bank has to pay to the government and that amount is to be recovered from the borrower. Bid bond guarantee. Bid bond guarantee are typically used in tenders to ensure that the winning bidder undertakes the contract as per the terms of the winning bid. In case winning bidder does not perform the tender requirements, request the author to treat us the minimum 10 years of post-qualification. Some of us have run the banks. Please focus on the treatment of contingent liability, not to teach the products. Just indication of how it works is enough. Correct. But here it is a mixed people. It is a mixed people, sir. That's why that even contingent liabilities, what type of the contingent liabilities, that is also very much required. Next, in case of winning, the bidder does not perform the tender requirements as stipulated, the tender can issue the bank guarantee for future of the amount. After this is over. Once the letter of credit is over, then we will switch over to the important aspects and the quote editions also. Because this is a 4 hours class, up to 5 o'clock, I have to teach this subject. And if the different types of bank guarantee, different types of LC are there, then the resolution applicant, professional or interior may have an idea whether any LCs are there, what is a revolving letter of credit, what different types, because it is a mixed group. Some may not have the full idea about the contingent liability. Anyhow, once this is over, next the real situation will happen. In case of winning, the bidder does not perform the tender requirements as stipulated, then the tender issue can revoke the bank guarantee and fulfill the partial forfeiture of the amount. Thereby, bid bonds are mainly winning the bidder performs as per the tender requirement, winning the tender. Why I told all these things means today, the guarantees and the letter of credit, the companies are enjoying more when compared to the fund-based limit like working capital and the term loan. Financial guarantee. The financial guarantee undertaken by the bank to take the responsibility for another company's financial obligation. If that company does not meet the responsibility, the bank provides financial guarantee mostly between two related parties, that a partner company providing the financial guarantee to a subsidiary company. This type of financial guarantees are also given by the bank. Advance payment guarantee. An advance payment guarantee is to protect the advance payment made to the buyer to the seller. In case the seller fails, deliver goods or services as per the terms of conditions, then the buyer can invoke the advance payment guarantee to recover the full or partial advance amount made to the seller. Advance payment guarantee is also used international trade transaction and a domestic transaction wherein large advance payments are made to the. This advance payment guarantees are also mostly the banks are issuing. Number of cases, number of companies are utilizing this one. Foreign guarantee, international trade, particularly foreign guarantee is also there. bank issues of foreign guarantees for the benefit of foreign beneficiaries. Deferred payment guarantee. Deferred payment guarantees are more when compared to other guarantees. Why? Because whatever the capex is there, capital expenditure, the machinery to be provided by the supplier to the companies, for that the supplier is fixing the installments. The installments are to be paid by the buyer. But if any installment is not paid by the buyer, then automatically the bank who is giving the guarantee, the bank will pay that particular installment. The deferred payment guarantee stretches for long period. Suppose it may be 10 years, it may be more than 5 years to 10 years like that. So the deferred payment guarantee is when one party in transaction undertakes to make the payment of fixed amount for corresponding times in the future. In case of debtor is unable to pay, then the deferred payment guarantee can be invoked, claim the money. Next, prior to providing the bank guarantee, diligence of the bank guarantee applicant may also request a collateral security, process the guarantee application following document. They are taking the request for the request letter, bank guarantee text, whatever the covenants are there in the guarantee. And if the company is taking the guarantee, board resolution is also required, and the collateral security and margin money is also required. Also note that contingent liabilities arise not only the several contractual obligation, legal suits not restricted only to LCBG. We are restricting only LCBG from bank today. Next, the types of letter of credit. This is also only 4 types of letters of credit I will discuss. Later on, we will switch over to the main area. A letter of credit is a legal document that is issued by the bank that acts as an irrevocable guarantee to make the payment to the beneficiary. In letter of credit, 3 parties are there. One is the issuing bank, second one is the applicant, third one is the beneficiary. So once any company wants to import the goods, the company is called the applicant, and the company's bank is called applicant bank, and the third one is the beneficiary who is export the goods is called the beneficiary. When the individual fails to perform the required obligation, the bank pays that one. There are different types of letters of credit is there: revocable, irrevocable, standby, revolving letter of credit. Others are also there: back to back, red clause, green clause. Bank guarantees are governed by Indian Contract Act. Letters of credit governed by UCP, this is ICC 600 brochure. Here, particularly the different types of letters of credit are there. Today, on account of globalization, the letters of credit, business of the banks are increasing. Corporates are also using widely the letters of credit. So once the company is facing the particular CARP process, definitely all these things are to be properly accounted for. Revocable letter of credit, as the name suggests, the letter of credit revoked by the issuing bank without agreement of the beneficiary. Revocable means at any time the issuing bank can be revoked the letter of credit. But in case of irrevocable letter, unless until the beneficiary consent is there, then only it is that contract, the letter of credit contract has to be cancelled. Till such time, it is called irrevocable letter of credit. Standby letter of, particularly if the company is a crude oil company ships oil to the foreign buyer, with an exception, the buyer within 30 days, the payment is not made and the required date, the crude oil shall connect the payment from the buyer's bank. That is called a standby letter of credit and a revolving letter of credit. If the revolving letter of credit is, the period will be given 1 year or 1 year. Each and every shipment, they need not take any letter of credit. This letter of credit is useful for 1 year, subject to a maximum. Once the earlier letter of credit is paid, then automatically limit will enhance. It is looks like the overdraft of the company, like cash credit or overdraft of the company. This is implemented where the regular shipments of the same commodity between the supplier and the customer. The said procedure eliminates the needs of the letter of credit for individual and transaction. The bank guarantee letter of credit has been regular. Opener should be known to the beneficiary. The overseas letter of should always be advised through Indian bank, preferably the confirmed bank. The parties are particularly trade parties, the banks are there. Issuing bank is there. Who issues the letter of credit is called a issuing bank and advising bank. Suppose if at all the guarantee issued by the issuing bank, the beneficiary may not know the issuing bank, then they will ask the one advising bank in their country. Through that bank only the letter of credit will happen. Confirming bank, whatever the issued by the issuing bank, whether it is a correct bank or not, that is to be confirmed by the confirming bank about the credentials of the particular opening bank also. Negotiating bank, once the letter of credit is issued, the export proceeds. If export goods are shipped, immediately they can negotiate with the particular negotiating bank. These are the credit options: site, usance, and deferred payment, and acceptance of credit. All these things are there. But in case of guarantee, bank guarantee, or letter of credit, no court intervention. But applicant can stop the LC issuing bank only through court injunction, because all are irrevocable letter of credit. Irrevocable, only the option available to the applicant is through court only. Otherwise, simply if at all he is giving letter to the bank, bank will not oblige. Now coming to the real picture, the recognition of a contingent liabilities under the code in the light of regulation 13-14 of IBBI and section 18(1)(b) of the IBC code 2016. So the recognition, that we will discuss about the recognition. Before that also, I will give the synopsis of the earlier discussion. Different types of guarantees are there. Different types of contingent liabilities, contingent assets are there. But here, most prominently, the corporates are using more when compared to other contingent liabilities are only the bank guarantees and the letter of credit. But here, the recognition of contingent liabilities under code in the light of regulation 13 and 14 of the IBBI regulations of the CARP process, or section 18(1)(b) of the IBC code. Then we will discuss about this. Now, any doubts earlier, sir? Because here the contingent liabilities, only everybody is talking about contingent liabilities means footnote of the balance sheet like that. But what are the various types of contingent liabilities, contingent assets, and the accounting standard? If at all we are having some idea, then if that cases are there during the CARP process, as an IRP or RP, they can properly address those particular liabilities also in various, particularly either in the information memoranda or the resolution plans submitted by the prospective resolution applicants, whether they are taken into account of these things are also. Otherwise, it is a big problem later on. Any discussion, sir? Any discussion on the earlier one? Earlier, whatever I discussed, any clarification or any discussion is there, sir? Sir, madam.
Sir, there is a question in some chat box. Can you just go
Ah,
through?
acha, acha, acha. Here I have seen, madam, earlier, only two are there.
Yes, sir.
That is only expressing why, because I discussed about LC and BG. Why I discussed that one? Because here different types of some of them are advocates, some of them are cost accountants, some of the company secretary, some of them are experienced person, managerial experienced person more than 15 years. But I should tell about the contingent liabilities. Understanding of the in the syllabus designed by the institute also, they told about understanding of the contingent liabilities. They mentioned clearly. That's why I discussed about the LC and BG. Why LC and BG? Why not the disputes or workmen compensation claims? So many things are there. Why I have not discussed? Because a major portion is LCs and BGs are there, but those items are very less. Very less. Okay. Now we will go through the recognition of contingent liabilities under the code. In
Sir,
the
can I express my views?
tell me, sir. Tell me, sir.
Sir, I'm Narayan Srinivasan. So we have come here to augment our knowledge and do the applications. And you have to involve us.
Correct.
Because it's a forum not only for understanding from you, we need to express back to you. So very importantly, you're with a very vast knowledge from the banking. We really appreciate it. But we want to know exactly that, that whenever you talk about a particular product, that where is the contingent liability getting linked to? So most of the time, if it is a going concern, we can understand what is your circumstances. You need to start from where, going concern almost comes to the stop most of the cases. Very few cases we are going to have a going concern. Going concern, then we need to see that, prospectively how these products are going to be structured, that we have to discuss. We would appreciate that, if it is a going concern which has come under CRP, what is the effect of the LCBG and how we are going to obtain it, how we are going to treat it in our books of account, it is fine. But this contingent liability arising out of this, particularly more important that the bank, the moment we call it a moratorium period, they are going to withdraw it if you are going to say. If it is a going concern, they cannot withdraw. If it is not a going concern, we need to see that, what is the impact of that on our books of account. You are describing a product, how it is structured. See, most of us, we know that how the banking works. We know that, the collateral is taken. So I appreciate that you have expressed it, but you need to also tell us, very good that there is a collateral attached. What is going to happen when the CRP happens?
Correct.
And how this asset to be treated, whether it will be secured credit or we need to treat them. What will be the impact of the secured liability in that case? How the asset is going to be considered in our the CRP process or the liquidation process?
Correct, sir.
CRP process is an entirely different process. Liquidation will be a different process.
Correct, here, this is a 4 hours class, and they mentioned about the what is the contingent liabilities that is to be discussed, the implication and all these things. When the cash margin, it is not only for going concern. It is not only going concern. So it is only, if at all it is not a going concern also, these are to be taken into consideration. Because if I don't know about the revolving letter of credit, or if I don't know various performance guarantee, suppose why I had told about the guarantee? Because their margin money is there and the collateral security is there. So these collateral securities, after meeting that contingent liabilities, then it is also useful to the IRP or RP for a distribution to the prospective creditors. So here, margin money. During CIRP, if at all any development is there, after expiry of the CIRP, if the particular development happened, all these things I will in due course, I will discuss all these things. It is
a very simple, straight question, sir. What is the situation of the CRP with the pending bank guarantee which is getting exposed? That is what we need to discuss. Where a guarantee, how it is going to be secured, that's where you have to link it back. Yes. You are doing the basics of the banking. We appreciate. We-
Sir.
Once again, let me complete it. My question, sir.
Banking.
My question is how that CRP process is getting affected because of this contingent liability.
Correct. I'm coming to that point, sir. I'm coming to that point. If at all I'm jumping to that point, here a group of people, okay, you may be aware of this contingent liabilities and letter of credit and bank. Others may not. Others may not. Okay, let us continue this one. Recognition of contingent liabilities. Now we will discuss. And the Insolvency and Bankruptcy Code, collective resolution mechanism. Claims of multiple creditors, different in nature, collated, the resolution professional or liquidator, as the case may be, which are then repaid from the recoveries made either pursuant to the resolution plan or by way of a resolution, realization of the liquidation process. This is the process of the resolution professional or interim resolution profession. But here, what happening in the practical is some of the people, they are forgotten to take into account of the various contingent liabilities. Thereby the problems are arise. In either case, to be able to recover the dues from the corporator, it is a pivotal role that party qualifies as a creditor with a legitimate claim as per the code. As per the code. And when crystallized the crimes can easily accounted for, probable problem of lies where the claims are either contingent or unascertainable. The big problem arises is the contingent liabilities. Sometimes it is a doubt, the probability or possibility, all these things are to be taken into consideration. Crystallization of the claims are very, very important. Once it is not a crystallized, then I am not taking into account of the list of claims. Though there have been various judicial developments in this domain, laws are still not settled. Uncertainty looms over the following questions. Whether the term claim defined under section 3, subsection 6 of the code includes within the purview of the contingent liabilities or not. Bank guarantee, letter of credit, or unfunded exposures, collectively called unfunded exposures. This is called unfunded exposure. Whatever I discussed is unfunded exposures. Funding means directly I'm giving loan, but unfunded means the guarantees only. If yes, what is the relevant factors for assigning this value of the claims? The value to be determined. I have to, at any cost, I have to arrive at a conclusion how much claims are there and how much assets are available. Then how much assets and claims, all these things I have to put into the information memoranda. If at all I simply leave that contingent liabilities and prepare the information memoranda and the expression of interest is happened, based on my information memoranda, the prospective resolution applicant will prepare the resolution plan, and so many cases are there, they have completely neglected this one. And whether the concerned creditor should form the committee of creditors or not, that is also a question mark. Bank guarantees, it is a claim only till it is crystallized. Once it is crystallized, it is a debt. Once it is a development is there, it is a debt. Once a debt with interest is there, definitely is a part of the COC also. At such time, it is a claim. It is a claim. But the claim also, the probability or estimations, how to estimate the claim. And for that also, accounting systems are there. Why I am talking about the provision? Provision, why? Because the possibility or the probability of the claim will happen. That's why I am providing the provision. ranging from the manner of valuation of the claim to inclusion of the creditor in the COC and consequently voting right. Once I have include the claims means I should not include bank guarantee as long as development is not happening. It is purely a claim. It is not a debt. Once it is turned into debt, then it is a part of COC. And according to the there is a debt, I have to give the voting rights also. Or the fundamentally in achieving the understanding of the objectives of the court. Contours of the claim. The expression of the claim is defined under section 3, subsection 6 of the code in two parts. Right to payment, right to remedy for the break of the contract if such breaks as right to payment. These are included under section 3, subsection 6 of the code. But here, right to payment irrespective of the nature can be fixed or disputed or undisputed or legal or equitable or whether it is secured or unsecured. Other side of the coin of the debt is defined in the section 3, subsection 11 of the code. While the claim involves right payment, claret, debt involves a liability or obligation to make the payment which is due. Claim involves right to payment, but a debt involves the liability or an obligation to make them. But in case of contingent liability, as long as the guarantee is not invoked, it is to be treated as a claim. After crystallization, after devolving, and once the bank is paid that amount, then they are stepping into the shoes of the financial creditor, and accordingly the voting right will also happen. Unfunded exposure do not have any current outlay of funds. Bank guarantees or letter of credit. Immediately the outlay funds will not happen on the part of the financial creditors. It must be noted, stress under the section 5, subsection 8 of the dealing with the financial debt is amount disbursed and not obligation or undertaking to disperse. Hence, there is no debt because it is not a debt. So here, there is a difference between a debt and a claim. Ongoing commitment, which if set will entitle the right of the recovery of the creditor. Therefore, in the given scenario, the right to payment not being existing or immediate or rather than contingent, anything. As such, debt is a contingent. One does not contingent debt gives rise a claim. As such, debt is a contingent one, does not such a contingent debt gives a claim. Authorities and laws across the recognized contingent terms as a part of the bankruptcy process. Bankruptcy process. In the chart also I have seen. Now, debts, all description are provable. Whatever the debts are there, all descriptions are provable. Provable debts explained in the Joint Administrator LB Holdings Intermediate UK Limited. First time it was explained in a provable debt. What is meant by provable debt? That is a scheme of insolvency. All potential liabilities should be capable of being proved so as to allow equitable opportunity to all the creditors to claim their debt. Even the debt is a contingent up to the date of bankruptcy. Up to the date of bankruptcy also, even a contingent is also provable. Electoral law also define the claim in the legislative guide includes the contingent liability. It is also defined in electoral law also. The guy talks about the admission of the claims. If you refer the page number 259 of the guide, claims also conditional, contingent, and not mature at the time of commencement. So it is also defined. Claims means may be conditional or contingent and not mature at the time of commencement of the insolvency commencement date. But the amount of the claim cannot be or has not been determined at the time of the claim. Is to be submitted. Many insolvency laws allow the claim to be admitted provisionally, subject to giving a notional value. Sometimes it is very difficult to estimate the claim, to estimate the value of the claim at the time of insolvency commencement date. But later on also, first you admit that one. Later on, you can revise that one. Day one, all claims are not 100% correct amount. Determining the value of such claims raises a number of issues, such as the time at which the value is to be determined, and whether it must be liquidated, in which will need to be considered by the court, or estimated, which might be undertaken by the insolvency representative, the court, or sometimes the appointed person valuers also. So, first admit the claim, sometimes even foreign exchange also. If at all any forex debt is there, how we are calculating? The Reserve Bank of India, whatever the rate determined on that particular insolvency commencement date, whatever the dollar INR rate is there, that we are taking into consideration. In the CIRP, pursuant to Regulation 14, if the amount claimed by the creditor is not precise due to contingency or another reason, IRP or RP, as may be the case, best estimate amount of the claim based on the information available. Sir, actually, we will give the break 3 o'clock. 3 to only 10 minutes. After that, up to 5, it will stretch, sir. Up to by 3 o'clock, we will break for tea, sir. In case of CIRP, pursuant to the Regulation 14 of the CIRP regulation, if the amount is claimed by the creditor not precise due to contingency or any reason, the IRP or RP, as the case may be, shall be best estimate of the amount of the claim based on the information available. However, IRP or RP shall revise the amount of the claim. Why we are talking about all these things means some relevance is there for the contingent liabilities. Once this is the ground that is prepared to estimate the contingent liabilities of the corporates. Because here we are revising amount of claims admitted when he comes across additional information. Suppose I take, for example, at the time of insolvency commencement date, no devolvement of bank guarantees there. Then no problem. But during CIRP process, devolvement was happened. Definitely that is to be admitted. That is to be admitted by the IRP or RP. Why? Because that is a debt. Accordingly, whatever the earlier, whatever your whatever your approvals are there, that will not affect anything. And from the day you admitted, then automatically the structure of the COC will change. Additional information warranting such revision. In case of liquidation, particularly pursuant to the regulation 25, liquidation regulation, if the amount of the claimant is not precise due to contingency or any reason, the liquidator shall make the best estimate of the amount of the claim based on the information available to him. The responsibility pass on to the IRP or RP or the liquidator. Because if the claim is not precise or whatever the problems are there, you have to estimate with your knowledge and all these things. Particularly, if you see the NCLT reliance on accounting standard 37, whether contingent liability is provable as claim. In the JEKPL Limited versus Exim Bank, this was spelled out. Or the committees of creditors of SR Steel versus Satish Kumar Gupta also, this was clearly mentioned. Here, the contingent liabilities, a lot of issues are there. Particularly devolvement before CIRP, devolvement during the CIRP, devolvement after CIRP. Second one is margin money is there with the bank. If at all everything is fine, the contract is completed, then the IRP or RP will get that 25% back from the bank. This is available funds for distribution to the creditors. Not only that one, 75% collateral security is also available. So all these things are there, particularly in this particular case, two cases also, the adjudicating authority given some clarity. NCLT reliance on accounting standard 37, but that's why I told about 37 of international accounting standards. That 37, what they told, earlier I discussed about 37, what they told. Disclosure of contingent asset. There is an international accounting standard 37 that outlines the treatment of contingent liabilities as well as contingent assets. This accounting standard, the Supreme Court has taken into account. And similarly, the Institute of Cost, the Chartered Accountants of India also published Accounting Standard 29 to deal with the same. If we go through this two, IAS 37 or the AS 29, then how to treat the particular contingent asset or liability. What AS 21 states, 29 states, the contingent asset should not be disclosed in the financial statement following the accounting concept prudence. However, the approving authority can mention the asset of their report. Approving authority, the balance sheet approving authority, those who are signing on the balance sheet, they like the managing directors or the company secretary or etc. etc. In this case of company, this will be reported by the board of directors. Whatever the contingent assets and the contingent liabilities are there. Suppose it is not reflected in the balance sheet. Then being a IRP or RP, you have to go to the board of directors report. How much contingent assets and contingent liabilities are there. Then I have to take into account for the CIRP process also. But such disclosure can be made report only. The economic benefit is probable. Once the probable is there, then only I have to take into account. The amount of such asset benefit is estimated reliably. So the Supreme Court of India also taken into account of this IAS 37 and 29. Now, I will discuss about JEKPL Limited versus Exim Bank. How to treat this one, particularly the contingent liabilities they have omitted. The RP is also not admitted. The contingent liabilities as on date of the commencement of the insolvency commencement date, it is not a debt. That's why he has not admitted. What is the consequences on account of that one? And in the committee of creditors also, SR States Limited, India, Satish Kumar Gupta also. These two I will discuss. BG claim is a debt or not? Bank guarantee is a debt or not? The IBC defines debt as a financial debt or operational debt. They have identified only two debts. One is a financial debt, second one is operational debt. Operational debt is an amount due to supplier for provision of goods. Everybody knows. And services including workers, employees, and dues. Dues owed to the government and others. While the financial debt is the amount disbursed. That is the point. But in case of bank guarantee, amount is not disbursed. Again, is the consideration of for the time value of the money. But in bank guarantees, time value of the money is not there. Because the debt is not a raise. But in case of the financial credit, financial debt, time value of the money is there. For that only, the interest is to be charged by the bank. Time value of the money. Today, 1 rupee is not equivalent to after 1 year, 1 rupee. So that's why interest is there. But in case of bank guarantees, time value is not there. Having seen the broad nature of the definition of the financial debt, we can say that all those entities or individual whose transaction with the corporate debtor is a nature qualify the financial debt, they are necessarily financial creditor. They will be part of the CBOS. The widely popular question, unless a guarantee has been invoked, once the guarantee is invoked, it does not become a debt. Once the guarantee is invoked, it will turn into debt. Till such time, it is a claim. One of the major reasons being the disbursement of an amount against a consideration of time value is an essential requirement to define the financial debt. Time value. But in case of guarantee, there is no time value. Debt amount is not disbursed. The funds outlay is not there from the bank side, or inflow of funds are not there to the corporate. Whereas in case of bank guarantee, there is not any disbursement of fund done. And only upon invocation, there will be amount dispersed, which itself is a contingent event. That's why it is a contingent event. Therefore, before invocation, non-fund based utility facility is a claim. Before invocation, the bank guarantees or letter of credit to be treated as a claim may become a debt only upon invocation. Once it is devolved or invocation is there, then only it will turn into debt. However, obligation the bank issuing the guarantee is absolutely under law. The bank therefore decide to stake in the process of if any time guarantee gets invoked, then there is no difference between a bank, the banks who had extended the loan and the bank who has issued the guarantee on behalf of the corporate. There is no difference. Once it is invoked, the bank guarantee as well as the debt, there is no difference. At such a time, it is only a claim. It is only a claim. Once it is devolved, invoked, then it is a turn into debt. This matter is heard by the Honorable NCLAT in the case of Export-Import Bank of India, the resolution professional JEKPL Limited. The relevant portion is reproduced here. Therefore, only that portion only I copied here. We hold the maturity of the claim or default of the claim or invocation of the guarantee claim amount has no nexus with the filing of the claim pursuant to the public announcement of section so and so, so and so. For the purpose of collating information relating to assets, finance, and the operations of the corporate or the financial position of the corporate, including liabilities as on date of initiation of the resolution process as per section. It is the duty of the resolution professional to collate all claims and verify the same from the records of assets and liabilities maintained by the corporate debtor. Even though it is not a debt, bank guarantee as on date of insolvency commencement date is not a debt, still being a IRP or RP, you should have collect the information, collate the information and particularly the list of claims also. It is a claim. Till such time it is a claim. In resolution profession, JEKPL, prior to the filing of appeal to NCLAT, the honorable bench of the NCLT in Delhi rejected the claim of the bank, Exim Bank, stated that the date of admission under CAFA, the claim is a contingent as a guarantee has not been invoked. That's why they have rejected when at the date of admission. It is also concurred with the views of the RP in case of the moratorium under section 14 does not permit invocation of the guarantee once the corporate has admitted under CARP. The COC in this case is also believed that the claim unmatured. Maturity is at the time of expiry or invocation. And a guarantee cannot be accepted as a debt has not become due or payable. That's why they have rejected. NCLAT has rejected that particular Exim Bank the guarantee. The Honorable NCLAT differentiated between the claim and the default. The appellate tribunal held that the insolvency has been triggered, then everyone has a right to payment, can file a claim with IRP or RP. Definitely. And the claim is not matured, cannot be ground for rejection of the claim. Once it is not matured, you should not simply reject it. That's why what I told is during CARP also, whatever the claims are there, particularly with regard to bank guarantees also, you have to admit whether it is not matured or not. Here, one point is there. Kindly give the case law referred with the reference contingently, the circumstance treatment be provided, please. Yes, sir. Definitely, sir. One beautiful article also written in this regard, only the bank guarantees. It starts from what is a bank guarantee and ends with the NCLT, NCLAT and Supreme Court judgment on the bank guarantees. Whether to include or not to include that bank guarantee in the CARP process or liquidation process, whether it is invoked or not. And what about the margin? What about the collateral? All these things are mentioned clearly. That is a beautiful one. Published by ICSI.
Sir, very pertinently, can you please tell us whether this claim of the bank, the RP should accept it as a contingent liability or should we accept it as a liability?
Sir, it is only claims are to be admitted. That's all. It is, sir, once the claim is, what the appellate authority held that insolvency has begun triggered, then everyone has to right to payment can file with IRP or RP, and that the claim has not matured cannot be ground for rejection of the claim.
It has to
Whatever,
be, but
what-
it can be accepted as a claim.
yes.
But will that be like, that some of the, if it is a going concern, I'm not sure whether this JKPL was a going concern or not.
Yes.
If it was a going concern, and if there is a certainty of performance, why would the RP to admit as a liability?
Sir, why? Because it is going to be happened after CIRP process. Okay. That company you are going to take over as a resolution applicant. And this information also I have to give it to you. I have to pass on to you. In case that happened, then automatically some responsibility or liability is from the resolution applicant also. Prospective result. Whenever the prospective resolution applicant going to acquire the particular company, then this is also to be taken into account. Whether it is viable, economically viable or not.
No, considering the circumstances,
Sir.
if the certainty of performance, because it's a export import, and if the obligations are going to be met,
Sir.
and the RP believes that there is no need, he can he is going to be the default CEO of the company. He believes that the performance is suddenly possible. He has to run the company if it is a going concern, or he can fulfill the obligation if he knows the product is ready, he's going to export or do take up the material. Then why it should be considered as a liability?
Sir, it is not a liability if at all it is not invoked. Okay, it is a claim. It is a claim. These claims are to be informed to the prospective resolution applicant. Why? Because for that also some rationale is there. What is that rationale? What is that rationale? Clean slate theory. Clean slate theory is there. Once you are not mentioned in your information memoranda and that is not figured in the resolution plan submitted by the resolution applicant, and finally that NCLT is approved that a particular resolution plan, thereafter number of claims are filed with various courts, and it is a burden or problem to the prospective the resolution applicant. To avoid that one, these claims are to be mentioned. That's why here the clean slate policy means once it is signed, he need not pay anything, whether it is a government dues or whatever it is there. That is, but still some cases are there. Even after clean slate policy theory also, still it creates a lot of a headache to the resolution applicant. Why should I take this company? The MCLT told that it is a clean slate theory. You need not pay whatever you have mentioned in the resolution. You have restricted that amount. After that, a lot of cases are filed with various courts. To avoid that one, some importance is there for the contingent liabilities. Later on, I will discuss that. That all are I am having an idea, sir. I will also discuss that one, sir. Okay, sir. Sir, next, the Honorable High Court and the claim is not mentioned. So here, it is one of the area of the IRP or RP. Don't neglect the contingent liabilities. For that purpose only, what is a various contingent liabilities? If at all you are having good idea, definitely your role will be an efficient or effective manner is possible. With reference to the admission of the claim, for uninvoked BG, often other kind of argument has been also been seen. It is not invoked, uninvoked. As the whole amount of the debt of the claim is a contingent upon the invocation, bank guarantee. So keeping in mind of the regulation 14(1) of the CARP regulation, finding that the Honorable Supreme Court in the Committee of SR states, all bank guarantees are admitted at INR. And the case that gets invoked during the CARP period, a fresh claim equivalent to the BG amount honored by the bank will be filed by the bankers and the whole amount shall be admitted. During CARP, if at all any invocation was happened, you have to admit. There is no other way as per the particular Supreme Court judgment on particularly SR Steel India Limited versus Certi. As on always we are thinking about the insolvency commencement date. Not only insolvency, during the CARP period also, the IRP or RP is an under obligation under section 18 1B, that is sections, chapter so and so, receive, verify, collate all claims are submitted by the creditors in pursuant to the public until the end of CARP. That is underlined. Until the end of the CARP, that is to be underlined. Further, as per section 221, 1 and 2 of the code, IRP shall, after collation of the claims received against the corporate debtor, determination of the financial position of the corporate debtor, constitute a company which shall comprise of all the financial creditors. Then only, from time to time, sir, the COC will also change. Once it is devolved or invoked, the debt will create. Once a debt means that is to be revised. The COC, the voting rights and all these things are to be revised. Sure, sir, that is correct, sir. Narayan, sir, that is correct. Once the percentage will recalculate.
Yes, sir.
That is to be recalculated, sir, correct.
Thank you, sir.
Otherwise, that's why, sir, even everywhere some in the sections also some leverages are there, sir. The leverages, whenever the adjudicating authorities are given judgments, the leverages throughout that CARP process until the end of the CARP. Once that leverage is there, why not we admit that invoked guarantee during the CARP process? What is the problem? They will ask like that. Okay. Some claims are not admitted, or later on you have admitted. Whatever the resolution process, that will continue as a status quo. You need not change. But after that, whatever the particular meetings are there or decisions are taken, revise this one. Everywhere some leverages are there. So all the financial creditors. Now we will break for tea, sir, for 10 minutes. After that, up to 5 o'clock, we will continue, sir. Okay, sir?
Okay, sir. Thank you.
Excellent session.
Thank you. Sir, actually, all these things are But I want to tell from basics onwards. These are the major areas, sir. Loan and simply whatever the figures are there, if you jot down, that is not the criteria. But what are the contingent liabilities? Some basic knowledge is also required. That is my the idea. But whether it is acceptable or not, that I don't know.
Very interesting, sir. Very interesting.
Thank you, sir. Thank you, sir. Shall I start now, sir?
Sure, sir, you can start. I guess everyone is back.
Okay, madam.
Okay, sir.
Further, section 21, 1 and 2 of the code, IRP shall, after collation of all crimes received against the corporate debtor and the determination of the financial position of the corporate debtor and constitute the committee of creditor, shall comprising all financial creditors. So, complete that particular task, the IRP or RP to be careful, not only the particular liabilities and other things, contingent liabilities are also to be taken into consideration with accuracy. Non-fund based facility provide us or amend or update their claims as and when they require. And the RP, this is a Supreme Court judgment. And the RP should provide a resolution applicants the updated list of claims. As per regulation 12A of the regulation, a duty is cast on the creditors to update the claims. As and when the claim is satisfied, partly or fully, from any source or manner after the insolvency commencement date underlying. Not only on the date of insolvency commencement date, whatever the claims, that is to be revised and modified based on the proofs and other things. Further, under regulation 14.2 of the IRP can revise the amount of the claims admitted as soon as he may be the practical when he comes across additional information. Your responsibility. Once you have got the additional information, you have to update. That is not a static one. It is a dynamic one. Crimes process is till completion of the CIRP process, warranting such revision. Hence, it is cannot be said upon the invocation of a bargain guarantee or its expiry, the RP shall request for fresh claims to be filed by the respective creditors, and upon non-receipt of the claims within the reasonable time, IRP can amend the claims on its own, and update the list of creditors. Even though you are not received, you have to estimate the best estimates of the creditors. Some of the creditors may not file, but you have to arrive at the conclusion. Why? Because you are going to hand over the company to the another person, that is a resolution applicant. For that, lot of cautious approach is required for the IRP or RP. Decision of the valuation of the contingent liabilities under IBC with regards to section 171(5) and 171(6) of IBC 2016, and the essentials for checking points during valuation process. Here, the contingent liabilities are also to be valued properly. Under even in bankruptcy also, individual bankruptcy also. This is defined under section 171(5) and 6 of the IBC, and some essential checkpoints during valuation. One 171 clearly states proof of debt. The bankruptcy trust shall give a notice to each of the creditor to submit the proof of debt within 14 days of preparing the list of creditors under section 132. For every proof, because now I am handling the personal guarantors of the corporate debtor, the Deccan Chronicle Limited. One of my friend is also insolvency profession, IP. I asked, But what is happening? CIRP constituted, but whatever the claims I received, I jot down that one and submitted to that NCLT like that. No, boss, have you verified the claims submitted by the people with the records available with the company? Or are you verified the balance sheet, how much claims, how much liabilities are there, how much claims are submitted? That information is also to be provided. Simply, if at all 100 crores liabilities are there, if 30 crores claims, if simply submitted, that is not the role of the IRP or RP. The proof of a debt shall require the creditor full particulars of the debt. That is defined under that section, including debt on which the debt was contracted and the value of which a person assesses. Require the creditor give full particulars of the security, not only the debt, even bank guarantee. Suppose a claim is admitted, simply claim is admitted, not the criteria. How much margin money? How much collateral security have to given? What is the period of the particular bank guarantee? What is the claim period? Normally, the claim period will be given 3 months. And the purpose, the copy of the guarantee also, bank guarantee, you have to ask, because that is comes under the claims. In that claim, the company assets are there. Company margin money by way of a deposit is there. That claim period is there. The guarantee period is there. What is the conditions of the guarantee? That also you have to take. Contingent liability means not, it is a dangerous one. Be such form or manner as may be prescribed. In case of the creditor, is a decree holder against the bankrupt, a copy of the decree normally. That is also to be admitted. Once admitted, the appropriate authority, competent court, the decree copy is also to be submitted original, or that is to be certified. Where the debt bears interest, the interest shall be proved as a debt except in so far as owned by the respect of the period. Suppose in CIRP. In CIRP process, one guarantee is invoked. Immediately bank debited that amount and created one debt, started interest rate. Whether that interest is a correct interest or not, you have to verify with the bank guarantee given by the borrower, that is a corporate debtor. You have to verify. Where the debt bears interest, the interest shall be provable as a part of the debt, except in so far as it owned in respect of the period after the bankruptcy commencement date. The bankruptcy trustee shall estimate the value of the bankruptcy debt, which does not have a specific value. Even though the value is immediately not arrived, you have to arrive. You have to arrive either through values or some logical conclusion. The value sent by the bankruptcy trustee under section 5 shall payable to the consent creditor. That is amounted to be paid to the consent creditor. A creditor may prove the debt where the payment has become due at the date later than the bankruptcy. The date which is owned presently may have received dividend in such a manner as may be prescribed. A creditor may prove for a debt where the payment has become due at a date later than the bankruptcy, the date which he owned presently, and may receive dividend in a manner such may be prescribed. Dividend means the rate of interest, whatever the investment that carries some rate of interest, etc. The bankruptcy serves the notice under subsection 1. The person whom the notice is served does not file a proof of security. Within 30 days after the date of service of notice, the bank receives with a leave of the adjudicating authority, sell or dispose of the property that was subject to the security, free of that security. Proof of security is also required. If they have not submitted, with the help of adjudicating authority, you can sell that particular security also, dispose of the security also, with the prior approval of the adjudicating authority. Contingent liabilities, valuation. Valuation part now I am discussing. That is also very much required. Contingent liabilities are those liabilities which may or may not arise for the future payment. The IRPR should ensure that all known, unknown liabilities have been accounted in the books of accounts, have been shown in the balance sheet. That's why, had I been an IRP or RP, along with this, first I will call the CFO, Chief Financial Officer. How many guarantees are issued? How many guarantees you have taken? Or how many guarantees in the company name? Because if at all he is an exporter, he will receive the guarantee. If at all he is an importer, he will issue the guarantee. Both sides are there. Letter of credit, both sides are there. All these things are to be properly. Sometimes, some guarantees, letter of credit, I told about red clause. The importer will give some advance to the borrower, to the corporate debtor. All these things, because here estimate ought to be done by the IRP or RP perfectly. Is a role. If at all I am not taking into all these things, red clause or green clause, what is this nonsense? I leave it like that. Then later on, it creates a problem. Later on, I will discuss some cases also. The following were the examples of the contingent liabilities. Even though I highlighted only two, bills are discounted. Sir, today, trade finance is there. Bank is giving, they are giving the bills. Bank is discounting and 90% they are giving. If that bill is not paid by that particular the debtor, then the company has to pay. For that bill of exchange, they will give. Liability gone on partly paid call shares. Even the first call, second call is there, share capital. Normally they will issue for first earlier. Now some companies application money, first call, second call, final call. If two calls are paid, you have to recover the amount from the shareholders, the remaining calls. The liability on arrears of dividend on cumulative preference. Preference shares are two types. One is ordinary preference shares. Second one is cumulative preference shares. If that company is not paying last year profit, this year profit is there, then the last year profit percentage, 20% or 10%, whatever, this percentage also. That also. But here, the areas of dividend, particularly bills risk, it is not appeared in anywhere in the balance sheet. Liability of guarantee, just I told about the liability forward contracts. Sir, contingent liabilities means not restricted to LLC, bank guarantee, etc. If you see the big corporates, they are booking forward contracts. Forward contracts to mitigate the forex transaction, to mitigate the risk of foreign exchange. Derivative contracts, either futures or swaps or options, so many are there. All these things are to be arrived while arriving the conclusion on how much liabilities, how much assets. That is our role. That is our IRP or RP role. Liability arising on account of litigation Today, various labor codes are there. Workman compensation or some incentives, bonus. All, if at all the associations or unions are approaching the labor code or this one, they will give the judgment. How many? Not only this one, labor shoots, trademarks, copyrights, all these things are to be taken into consideration. But here, calculation. Ensure creation of adequate provision. The IRP should ensure that the proper provision has been made. Certain liabilities, for example, liability arising on account of litigation. If he is not satisfied, facts should be stated in the report. Actually, what is a litigation? Sir, some claims that this litigation, all these things, nobody will claim. It is available in the balance sheet. Through provisions also, we can extract some liabilities, contingent liabilities. Why they have provided the linkage, disclosure in balance sheet. In respect of certain liabilities, no provision is made, particularly bills and receivables. You are taking the bills and receivables and it discounted the bank. If that bills and received are they not paid on due date, 30 days or 60 days or 90 days, whatever it is there, then it is converted into debt and discounted arrears on account of accumulated fixed dividend. The IRB should verify such liabilities or disclosure at the footnote or not. You have to verify. Evaluate the event likelihood. Sir, best estimates, they simply put one best estimate in the law and you are responsible. If a contingent liability is a material amount or the amount cannot be estimated, the IRP or RP should estimate likelihood that the event will occur or not. The likelihood can be remote, reasonable, possible, and probable. Probable, definitely you have to account for. US generally accepted accounting do not offer specific percentage of definition for all these things. IRP or RP must use a professional judgment. The company must disclose the material contingent liabilities that are possible or probable by verifying the footnote of the financial statement. You have to verify. COC you are conducting, valuation you are not conducting, forensic audit you are not conducting, only the minutes are to be jotted down by the executive. And whatever the resolution plans are there, evaluation matrix, you are verifying and present the same to the COC for the decision. But here, whatever the information you are providing to the COC or adjudicating authority, accuracy is very, very important. Later on, consequences are there that I will discuss later. Look at the probable events. IRP should pay special attention to any contingent liability in the probable category because they may require special accounting treatment. If the contingent liability is probable, but the amount cannot be estimated, the liability normally disclosed in the footnotes on. However, the liabilities are probable, can be estimated, need specific accounting journal, particularly IRP or RP should ensure the company debit and legal expenses are not, all these things are to be verified. Now, clean slate theory. Once the resolution plan is approved by the COC and submitted to the adjudicating authority, whether he commercial wisdom vested with the COC only, everybody knows about that one. But whether you are following all the guidelines of the rules or regulations or code, then the adjudicating authority will verify and approve the same. Once he approved, whatever the further dates and all these things all are to be accepted the judgment of the particular NCLT. Recovery proceedings by creditor, post approval of resolvent, that is happening. That's why we have to mention in our claims to be admitted. In the claims admission process, you have to mention all these things. In the light of a clean note, clean slate theory. Recovery proceedings by creditor. Some of the people after resolution plan is over and handed over to the resolution applicant, still the resolution applicant or the new person is facing lot of problems. To avoid that one, you have to mention in information memoranda about the contingent liabilities. You have to verify whether it is figured in the resolution plan or not. That is to be verified. Then only the clean slate theory perfect. Otherwise, later on, it creates a lot of problem. The provision of section 31(1) of the IB code, apart from bestowing the final power on the adjudicating authority in approving the resolution plan, also significantly stipulates that approval by the adjudicating authority renders the resolution plan binding all the stakeholders. Once it is branded or signed by the NCLT, it is binding all the people, all the stakeholders. Namely, who are the stakeholders? Whether it is a corporate debtor, he has to bind its employees, its members, its creditors, including central government, state government, local authority, whom debt in respect of the payment of dues arising under the law, time being in force. Such authorities to whom the statutory dues are owed, its guarantors, other stakeholders involved in the resolution, all are to be bind, because that is a final copy of the resolution application. Whatever the resolution plan approved by the adjudicating authorities is final and are binding on that particular judgment. Even central government or state government, if at all dues are there, that is fine. But that's why in the resolution plans, to avoid or to, after that particular resolution plan is over and handed over the company to the resolution applicant, he should not suffer. If at all it is not figured that contingent liabilities either in the information memoranda or the resolution plan, then the problem is more to the resolution applicant. Further, from the phraseology used by the Supreme Court, in its ruling SR Steel and versus Satish Kumar Gupta, the idea behind this provision is Hydra head popping up. So here, particularly the Hydra head popping means it containing many problems, difficulties, obstacles. So to avoid that one, all are to be taken into consideration by the IRP or RP. In some cases, some of the IRPs, they are overlooking some of the liabilities. Thereafter, many problems to the new promoter, particularly the resolution applicant. He is facing a lot of difficulties, lot of obstacles. The clean slate theory prevents any past claims for resurging, thereby throw into uncertainty amount of a payable by prospective resolution applicant who successfully take over the business of the corporate debtor. today we are discussing about the contingent liabilities means on the insolvency commencement date, it is not a liability. Later on, it will become a liability. In the CIRP process also, you told that this is this 180 or 2 sign is not file any cases. All are, it is a calm period. In that particular period also, everybody is keep quiet. Even though my client, my attachment of the property is there, I should also stop. The idea behind the resolution plan is moratorium. The 180 or extension of 90, 270, or in certain cases 60, total 330. The moratorium put halt all the pending liabilities. If at all liabilities are the pending liabilities, and the claims of for and against the ailing debtor, for against. Some of the claims are also there. The partly paid shares, so you have to recover. So the resolution process can go smoothly and the bidders can access the balance sheet with some degree of certainty. Even adjudicating authority no jurisdiction to entertain any application for rectification, alteration of a resolution plan, or any pretext after completion of the resolution process where resolution plan was approved and implemented. So before that only, whatever the measures are there, all are to be taken care by the IRP or RP. Whether it is a liabilities, real liabilities or contingent liabilities, whatever it is there, all are to be taken care properly. Micro level management is very much level. Otherwise, the prospective resolution applicant will face the problem. Even adjudicating authority no jurisdiction to entertain a new application or rectification or alteration of the resolution plan after completion of the resolution. That's why once it is a final verdict of the resolution plan, then lot of care precision is very much required. The Supreme Court in SR Steel India has opined that all claims must be submitted to and decided by the resolution professional, so that the prospective resolution applicant knows exactly what has to be paid in order that it may take over and run the business of the corporate. If at all you have not mentioned about the contingent liabilities, he is in dark. He will contest. No, sir, in information memoranda, he is provided to me after the expression of interest. And accordingly, I have submitted the resolution plan. This resolution plan approved by the COC and finally approved by the adjudicating authority. Today, somebody is claiming that property, that is a contingent liability, this is a liability, that is a liability. Then always, even though he acquired the company, still he is facing a lot of problem. To avoid that one, all claims are to be properly valued, properly admitted till the closing of a CIRP process. That's why I have given all the sections, all the regulations, all the background. Definitely, I will ask. Contingent liabilities, not only contingent liabilities, other liabilities also, micro level I will prepare. Once I prepare the final statement, it should be 99% pakka, plus pakka. Explain the rationale behind the same. It adds that this is a successful resolution. Applicant does not does on a fresh slate. Explain the rationale behind the scene. It adds, this is a successful resolution applicant does on a fresh slate. Otherwise, one side he has to run the sick company. Second side, if at all after CIRP, some cases are filed against the company, he has to answerable, he has to attend for the court. How he will concentrate? We are talking about going concern and other things. We have handed over the company and some items are not mentioned. By virtue of the amendment of wide insolvency and bankruptcy 31(1) is further clear, mandating the resolution plan is binding on creditors that include central government, state government, or any other local to whom the debt is respect to payment, dues arising under the law for the time being in force, such as authorities whom the statutory dues are owed. Otherwise, state government or central government, they are also approaching the courts even after CIRP also. By virtue of the amendment of the Wide Insolvency Bankruptcy Code Amendment Act 2019, Section 31(1) is a further clear mandating, clear that the resolution plan is binding all the creditors that include the central government. They clearly mentioned earlier, it is not there. State government, local authorities, any taxes to whom the debt in respect of payment dues arising under the law for the time being in force, such authorities to whom the statute dues are owed. Particularly the Supreme Court of India, Honorable Supreme Court of India, in Ghanshyam Mishra and Sons Private Limited, Edelweiss Asset Reconstruction, by upholding the validity of the amendment of the to Section 31, termed as a clarificatory and a declaratory in nature, therefore same effective from the date of IBC coming to the effect, not from the date of amendment of the Act. From the date of IBC code coming to the effect. Application of SR still and a clean slate theory. What was happened in SR states, particularly with regard to clean slate theory? The Supreme Court judgment. What is the facts of the case? Why they have mentioned a clean slate theory in SR states? Application of SR still and clean slate theory case amended the provision and the parliament discussion on the same was noticed by Rajasthan High Court in its ruling Ultratech Nathdwara Cement Limited and Union of India. What is that one? The High Court, following the laydown of the Supreme Court in SR, gave the effect of a fresh slate theory. In this case, Ultratech Nathdwara Cement had taken over the Binani Cement after emerging the successful resolution applicant and had paid the dues to the department in terms of the resolution plan. All are perfectly paid and acquired that particular company. The High Court, applying the theory of a fresh slate, cashed the demand notice of the goods and service department issued by Ultratech Cement, which is a successor bidder. After that, the goods and service GST department issued a notice, but the High Court is a trash. The court, applying the theory of the fresh slate, cash the demand notices of the GST department issued under Ultratech so and so, the successor of the Binani. After Binani successful underwent the resolution process. In Ultratech, the Rajasthan High Court held that the amount specified in the approved resolution plan is final and binding all the parties, irrespective of the fact whether the claimant has been heard in the resolution profession or the committee of creditors. It has been argued elsewhere on the most occasions. The claims are duly collated and verified by the insolvency professional or resolution profession. The theory clean set applied to all the instances of all pending claims, disputed claims, unclaimed claims, and the claims are submitted belated stage also. All are to be taken. Even belatedly claims are also to be taken into consideration. Similarly, the claim of a creditor, that is a secured creditor, has declined because of a contracted charge was not required by the section 77 of the Companies Act 2013. Similarly, claim of a creditor, that is a secured creditor, has also been declined because of contractual charge was not registered with section 77. Registration of charge, ROC, within 30 days. Maximum period is 300 days with a penalty. Whenever the banks are giving loan, immediately they have to create the charge with ROC within 30 days. But here what was happened? The bank is not registered with ROC under section 77 of the Companies Act 2013. Thereby, resolution professional decline. The NCLAT further observed it is only when the resolution plan was approved that charge was registered. Taking into account that the NCLAT did not accept the argument of the appellant creditor to stake the claim of being a secured creditor. At that time, no, you are not a secured creditor. You have not registered with ROC under section 77 of the Companies Act. The Supreme Court of in Ghanshyam Mishra, in the light of section 31, even held that the claims of a labor workman once considered in the resolution, then the grant of liberty to the workmen to raise their claims before civil court or labor is in the conflict in the provisions of the IBC code. The Supreme Court in Ghanshyam, light of the 30, even held that the claims of the labor and workmen once considered in the resolution plan, then the grant of liberty to the workmen to raise their claims before the civil or labor court. Furthermore, NCLAT imposed certain conditions on the approved of the resolution plan. Successor resolution applicant, the NCLAT has set aside the same. The NCLT directed that if the amount is recovered from the corporate data, which was due from the third party, but written off the bad debts, or which stood in the books, but not has been recovered of the debt date, resolution plan was approved, such amount can be used to balance the dissenting financial creditor. What they told is, if at all any written off accounts are there, particularly debtors, the company will write off. Later on, if the amount is paid, that amount can be paid to the decent financial creditors. Like that, the NCLAT has given the judgment. And finally, the NCLAT is setting aside the same, held that the right of receivable lies with the successful resolution applicant. If any subsidiaries or associate joint venture privilege of the client now stood extinguished after the approval of the so-and-so, if the successor resolution carry forward losses in terms of section income tax, all these things are there, set aside the scheme. And that's why all this are, if the resolution plan extinguishes the liability of the personal guarantor, Can the dissenting creditor go for guarantor to retrieve his money? Resolution plan extinguish the liability of a personal guarantor. Can the dissenting creditor go after the guarantor retrieve of his money? Sir, that is, you are talking about PG to CD, personal guarantor to corporate debtor. Personal guarantor to corporate debtor. Today, what is happening? Sir, what is happening? Suppose if the loan is taken by the corporate debtor from the financial creditor, the directors of the company are giving personal guarantee. CORP is completed. Take for example, the Deccan Chronicle also. The Deccan Chronicle, the Central Bank of India, they have given some loan. In the CORP process, they have recovered small peanuts. Immediately based on the guarantee given by the directors, again they approached the NCLT to recover the balance. One example I am quoting. Suppose in the CORP process, the financial creditor got out of 100 crores, they got only 50 crores. Remaining 50 crores, he can recover from the personal guarantors to the corporate debtor based on the guarantee given by the directors to the loan for that particular loan. That is called PG to CD. You are asking that one, sir?
Yes.
Except
Exactly.
they mentioned, sir, except the personal guarantees. Even all are waived except the guarantees given by the others.
Yeah, actually, sir, there's a hypothetical situation wherein the resolution plan accepted by majority of creditors extinguishes the liability of the personal guarantor. But there is a dissident creditor who wants to go against the personal guarantor and retrieve his money. So I'm wondering, that can happen or not.
No. Actually, here now today banks are going simultaneously, CORP simultaneously, the personal guarantor, the PG to CD, personal guarantor to corporate debtor simultaneously they are going. Why? Because they are jointly and severally liable. The bank is having a right to recover the amount either from the corporate debtor or from the personal guarantor. That's why the two applications are filed by the bank today, almost all corporates. Today, the directors are also not interested to act as a director in the company. Why? Because once the company is failed and the amount is not recoverable from the company, then the balance amount they are going to recover through the directors, that is PG to CD. Sir, any discussion, sir? Sir.
You are talking to me. I asked the question. Myself is Josie Stephen.
Yes, sir.
I asked the question actually with regard to the PG. You are asking me.
Tell me.
Discussion. No, same. I mean, I don't have any.
Okay, sir. Next, sir. Any discussion, sir? Sir, here, in almost all cases, the prospective resolution applicant is facing some problem. If at all liabilities are not taken into account while during the CIRP process. Ultimately, the problem is facing by the prospective resolution applicant. To avoid that one, we have to take a precautionary measure, that is IRP or RP, to verify the claims Verify the claims means not only with the proof and books of accounts also. Not only the books of accounts, even the contingent liabilities also. Some of the contingent liabilities, it will not reflect in the annual accounts. And we have to check it up with the legal advisor. What are the pending cases with the various courts? How much they claimed the amount from the company. Against the company, some suits are filed. That is also to be taken into consideration. Not only that one, the patent or copyrights or the product warranties claims. That is from the legal department. How many cases are filing or what type of cases? Whether any money involvement is there or not. That is also to be checked. That's why the contingent liability is a broad area and immediately it is not visible. It is not easy to get the information from the various sources, particularly the banks or the legal department. Whatever the pending suits are there, what type of suits, how much the amount involved, and how much amount to be paid by the company, all these things are required. So the conflict between a clean slate and the provisions of section 60, subsection 6. Clean slate theory has come to realize that going to face a resistance in its journey and evolves a principle. The same is essential. As literally critics may stress since the adding coating to the character by inserting the shades of the gray areas. Some gray areas are there in the clean slate. That is to be removed. Otherwise, it is not a clean slate. Even though the adjudicating authority is giving a clean slate, no, the prospective resolution applicant need not pay whatever the not mentioned in the resolution plan. But still, some of the cases are filed with various courts. Section 60, subsection 6 of IB Code stipulate the calculating of a period of limitation specified for a suit or application or against the corporator, for which the order of a moratorium has been made. The period during which moratorium is shall be excluded. Whenever the period of limitation also, during moratorium period, if at all I hold that one, my documents are valid. Why? Because the period of limitation, section 18 of the Limitation Act, that is, this is excluded, this period to be deducted. This throws the twist of the section 31 subsection 1. In circumstance, the creditor is allowed to pursue the legal remedies before the other forms after the moratorium ends. One side, the resolution plan approved by the adjudicating authority is a clean slate. Second side, the certain instances, the creditor is allowed to pursue the legal remedies before the other forms after the moratorium ends. That is under section 31 subsection 1. Both are contradictory. That's why the conflict between clean slate and the provisions of 60 subsection 6. What is the 60 subsection 6 of the IB Code stipulates? In calculating the period of limitation that completed, while this may conflict in the clean slate theory under section 31, it is submitted that is there may be still some room, and rightly so, maneuvers in the instances where the claims are judicially recognized to the pending or recognize such a resolution plan. Only such claims may be allowed to continue post approval of the resolution plan under section 31 of the code. 31 of the code, even after the resolution plan is over, still that is also carried forward. In NTPC Limited, one case I am discussing here, the issue came up before the Supreme Court, where the claim of the appellant creditor in the information memoranda was noted the title list of other creditor claims. That's why whenever the information memorandum, that is called marketing document, whenever your product is offering to other people, you are offering to whom? The prospective resolution applicant. Whenever you are offering that one, the information memoranda should be clear, crystal, accurate, precision, all is required. Based on that only, the origin of a resolution plan. Once the resolution plan is based on that, then nobody will comment to you. If it all not to mention some gray areas, later on it is a problem to you. In NTPC Limited, the issue came into the Supreme Court, where the claim of the appellant creditor in the information memoranda was noted under the title list of other creditor claims, whereas appellant wanted the claim to be categorized under the head of claims of operational creditor. The court noted the claim, and the appellant is pending arbitration and mitigated the fears of appellant holding. The claim of applicant had taken note of the information memoranda and does not extinguish such, but it will be subject to adjudication by the adjudicator. Since the part of the memoranda, it is obvious that a resolution applicant would take the same into account while submitting his proposal. Due notice whereof will be taken by the committee of creditors as well and dealt with appropriately in the final resolution plan. Clearly, the claim appellant would be accounted for and not wiped out by the sweeping of the section, even though the adjudicating authority in a case has directed the following. The resolution plan approved shall not construe any waiver to any statutory obligation or liabilities arising out of the approved resolution plan, and the same shall be dealt with according to the appropriate authority as per the relevant laws. This adjudicating authority is a considered view that if the waiver is sought in the resolution plan, the same shall be subject to approval of the authorities concerned. The above directions were upheld by the NCLAT. To conclude, the miniature on how the theory of the clean slate has come to evolve, the same is essential because of several times the claims may get reduced to nullity only because it could not include in the resolution plan pending the litigation in other forms. So here, whatever it is there, if you put in the information memoranda, particularly the contingent liabilities, then the resolution plan submitted by he should aware what are the total claims, whether it is a current claims or future claims. All are to be taken into consideration by the prospective resolution. Accordingly, he will prepare the resolution plan. And later on, if at all that is not paid by the particular prospective resolution applicant, then the claimants is having a right to approach the court to recover the amount. If at all it is not mentioned, then it will be a problem to the company also, particular problem to the resolution professional also. Are you getting my point, sir, here? Sir. Sir. Hello.
Yes, sir. Hello.
Tell me, sir. Tell me, sir. Now you tell me, what are the areas or doubts lingering in your minds, particularly with regard to contingent liabilities? Tell me, sir, one by one, we will discuss. Sir, any doubts, particularly with regard to contingent liabilities?
I hope the contingent liability, can I talk? Are you addressing to generally or are you asking anybody in particular?
Sir, again, tell me,
Can
sir.
I talk or are you addressing to anybody in particular?
All, sir, all people, whoever having some doubts with regard to contingent liabilities, particularly under CARP or liquidation, whatever it is there, I will clarify all the doubts, sir.
So first of all, thank you for providing a wonderful session. Now
Sir,
that I had posted one question, probably it superseded some other question.
Okay, sir. Tell me, sir.
The object of this contingent liability is arising because that resolution plan cannot wait for crystallization of all liabilities, right?
Correct,
So
exactly.
since it cannot be crystallized, we need to consider whichever is going to be treated as contingent and whichever is to be considered as a subsistence claim and settle it. Is it correct?
Sir. Correct, sir.
So accordingly, that all those that we are discussing,
sir,
should be related to that. I asked you an important pertinent request.
Tell me,
that
sir.
The case laws that you referred. What are the two circumstances or what was a decision given? One you had given already during your presentation.
Sir.
In the SRCL, what are the circumstances? It is crystallized, so obviously it has to be provided. Correct?
Yes, sir. Yes.
As regards the other company, what was the situation which has happened?
Second point, sir.
The other example which you asked, the Exim Bank, what was the circumstance and what was the decision given by the court?
The decision given by the court is.
I don't know what was the circumstance. Also, kindly tell us, sir.
Circumstance, sir. If at all we forgotten any contingent liabilities, later on, the courts will give judgment in favor of the creditors only. Later on, the courts will give judgment in favor, even though the resolution plan is finalized by the NCLT, still it is open. It is not a closed issue. It is not a closed issue. So in Supreme Court also, particularly, okay, up to CARP, whatever the claims is, CARP closing date, whatever the particular claims are there, all claims are to be accounted for properly. If at all any misplacement, if at all any missed are not accounted for, then later on, it is a problem to the prospective resolution agreement. To avoid that one, all are to be accounted for. That is the main conclusion of this contingent liabilities or whatever the other liabilities are.
No, it is not answering my question, sir. What was the circumstance in your Exim Bank and what was the verdict of court?
Okay, we will go to that Access Bank and the details I will tell. This one, Exim Bank, sir, you are talking about.
Right. JEKPL RP Exim
yes,
Bank.
Yes. That is to be considered. Actually here, Exim Bank, what the contention of the resolution professional in the Exim Bank is, the Exim Bank is not registered with the Reserve Bank of India. It is not a scheduled bank. And at the time of insolvency commencement date, the debt, whatever the debt is there, that is not not happened. Particularly, still it is a contingent liability.
Uncrystallized.
Sir?
Uncrystallized liability, because there was no purpose of BG invoking, the time period has not matured, right?
Yes. So that's why resolution professional, he declined, he rejected that particular Exim Bank claim, because one, it is not a bank. Honestly, it is a development bank. It is not a register, it is not a scheduled commercial bank. All scheduled banks are registered with Reserve Bank. It is not a scheduled bank. One plea is, that is, it is not a scheduled bank. Second one is at the time of insolvency commitment, debt is not arise. That's why he rejected that one. That Exim Bank, again, they approached the Supreme Court. Then they clearly told, registration with the Reserve Bank of India is not at all the criteria for the financial creditor. Second one is, during the CIRP process, the particular guarantee is invoked. That's why that is to be admitted by you. And in the meantime, what was happened is, without taking into consideration of the Exim Bank claim, they have finalized and the resolution plan is also approved. Later on, the Supreme Court version is that whatever the Exim Bank, that is to be considered. That is to be considered. Even though it is mid of the CIRP, invocation has happened, not at the date of insolvency commencement date is not the criteria. That's why they have admitted that particular.
No, they cannot invoke it because there is a moratorium. What they could have at best done is, the occurrence of the event has happened, so the crystallization of the liability has happened. So the crystallization of the liability has happened, so that even otherwise, whether it's a bank or not, this acceptance of the claim is not an issue. It can be accepted as a contingent liability.
But
That's
he is
not
not
done by the
admitting,
RT.
sir. Actually, here the contingent liabilities importance are arise from this case onwards.
No, even otherwise it should have been
before
considered.
that, sir, before that, that is 2007. Before that, nobody is recognized the contingent liabilities in CIRP process, because on the date of insolvency commencement date, it is not a date. That's why they are not admitting. But after the Exim Bank and the JEKPL, it is a CIRP process. It is after the insolvency commencement date. That's why they reserve the Supreme Court also, please admit that claim also. Even though it is rejected by the resolution profession on the two grounds. One ground is not a bank. Second ground is insolvency commencement date. It is not a date. It is only a guarantee. But at that time, claims are also not admitted by the resolution professional.
Okay, it is done erroneously because
erroneously,
it need not be a bank, and obviously the Supreme Court has rightly said it.
Yes, sir.
Thank you, sir.
Sir, any other discussion, sir? Any points for a further discussion?
I don't know. I should not be occupying the complete forum, so I would like the other participants to take the advantage of you being in the board now.
Sir, any other points? Any other points to be discussed with regard to contingent liabilities, sir?
Sir, may I?
Tell me, sir. Tell me, sir.
Sir, in liquidation, before the commencement of liquidation or before the commencement of the CARP,
Hmm.
there were certain agreements entered into or contracts entered into or settlement reached between the parties, wherein the RP was aware that this contract has been reached.
This
Some
contract has
settlement-
been
some settlement has been reached by the parties.
parties,
So
correct.
figure was fixed. A figure has been arrived. That figure is higher than the books figure, or
Hmm.
maybe in the books it was not there at all because there were some
Okay.
legal cases going on.
Yes, sir.
Now,
Yes, sir.
if a liquidator takes a stand that this figure is not appearing in the books of account,
Hmm.
is it proper or is it because his stand is right? It is not appearing in the books of account, but the
Sir,
settlement
that's
has
why
been
the-
agreed.
Sir, that's why PUF transactions are there. Preferential undervalue and extortionate and fraudulent transactions are there.
Mhm.
Under that fraudulent, 1 year non-related and 2 years for related party transactions are there. So if they have any contracts are made before the CARP process, that type based on the type of transaction that is fraudulent, if at all it is a fraudulent, then the NCLT will give the judgment accordingly based on the facts of the case.
May I just clarify further? Here, what has happened is that the contract was entered before CARP.
Before
Some
CARP.
part was executed. Now these are continuing contracts, those EPC contracts which are there. So in
That
that
is
they have to agree at a particular value. Okay, this work has been done, and that work is normally confirmed by the CD itself. Okay, this is the work which is completed. So there was dispute as to what work was supposed to be completed because in the books of account the complete activity was not recorded. Then a settlement was reached between the CD with the RP and who is now the liquidator also, and then it was agreed that okay, this much portion of the work was agreed to have been completed
correct.
and later on certified.
Correct.
So
Now I
what
got your
happened
point.
when liquidation claim is put forward, the operational creditor said that since this was agreed by the CD and RP was also present, and they have certified that this work was completed. Therefore, up to this amount, my claim has to be accepted. The liquidator is taking
No
a
problem,
step.
sir. Actually, if at all it is a genuine contract, not reflected in the books, but it is
Partially
the contract is a
reflected.
genuine one, then
Yeah,
it is
partially reflected, not the exact amount, because there were certain activities which were done, but not recorded in the books of account, which the operation creditor proved later on. Okay, these activities is certified by you, so please include it.
So no problem, sir.
CDSA.
No problem. Even some of the contracts they may be missed or not entered by mistake in the financial
Books of
accounts,
yeah.
financial accounts or books. There is no problem. There is no problem. If at all it is a genuine transaction.
It's a genuine. Okay, sir. Thank you, sir. Thank you, sir.
Sir, one clarification, sir.
Sir.
It's all possible only up to the 90 days of beginning, and beyond that, the RP doesn't have a right. He has to go to NCLT and plead the NCLT to do the approval, just for the procedural matter.
Correct.
No, for liquidation, the liquidator has been given adjudicating rights. So the with these rights, it is he who has to decide, and he cannot put the blame on or pass on to NCLT and say that for CRP yes, for liquidation.
No. Even on liquidation, kindly let's check the provisions. You have only up to a limited period. If the resolution plan is accepted, beyond that point, you cannot accept it. You have to go back to the NCLT because the crystallization has to happen. Otherwise, the loss will be happening to the rest of the creditors. Anyway, he may not be getting even 1 single rupee in the practical situation because it's operational creditor, you have said. Most likely that he's not going to get even a single penny because the financial creditor himself, in a practical situation, is going to consume all the money. Nowadays, the changes are happening still.
No, there are two concepts in liquidation. One is when the liquidation first 90 days when it is continued as a going concern, and if it is sold as a going concern. Second stage where it is not continued at all. So in the second stage, he has to accept. Even in the first stage, since the liquidation process is also continuing, no? He is signing as a liquidator. He has to open it as a liquidator.
So what is the circumstances when this liability has come? So he cannot keep on the estate.
Liability has been done earlier on.
Estate value, no, sir.
Yeah, that is true. What I am trying to say, even during CRP period, the RP was fully aware that this type of settlement has been agreed with the CD and the figure has to be changed. When he became a
So
liquidator,
if he is
the step-
aware, no, if he is
he's aware.
aware,
He's a part of
he
the.
should,
He's a part of the signatory of the tri-party or the agreement entered into. But still, because it is not in books, the liquidator says I'm not accepting it, or I'm not ready to.
no,
contract.
that I think my personal opinion that the availability in the books or not has to be seen beyond the facts of the case.
Yeah, precisely.
But he cannot decide on his own.
No.
If it is not available on the books,
Correct, sir.
cannot decide on
his own. Correct. Exactly correct. It is not available in the books, sir. But you have to take the concurrence of the adjudicating authority. Concurrence is required.
liquidator
Because,
cannot decide independently.
Independently, that is correct. That is true. 100% true. Correct.
But there is a difference between a liquidator's role and the role of a RP. RP is not authorized to verify the claim. Liquidator is an adjudicator who is responsible for verifying and also adjudicating the claim. There's a little difference between CRP and liquidation. The little
Sir,
big
here
difference.
also, liquidator also supervised by NCLT or not, sir? Tell me.
But it is the role responsibilities are a little different. It is just verifying the claim at the first stage of RP, but it is adjudication of the claim at the second stage of when it comes to liquidation. That is my personal understanding of the provisions. Of course, he can always go to NCLT and ask for the request. I mean, he
Yes.
can always come.
My
But on
humble
his own
submission,
basis-
your understanding seem to you need to go back to the book, sir. You need to get it clarified. In my opinion, that liquidator is also in the same position as the RP in a different platform. That's all. He is liquidator, but he is also governed by the same NCLT, and he cannot take any decision independently of the NCLT. He has to submit whatever is his observation to the NCLT and take the NCLT approval. Accepting the claim is different. In this case, accepting the claim itself is under the dispute. So you need to take a proper judgment, and the judgment he has to get it vetted by the obviously the adjudicating authority, the NCLT.
Sir, here sometimes you have to construct the books and construct the financial statements also. Because
Absolutely right, sir.
Here.
Absolutely right. He should have done that when he knew that in the first instance itself, corporate debtor, he should not have accepted the books of account on the side-through process. Even the audited financials. Today we are reconstructing because we are taking the special approach to reopen the books and reconstructing in cases where that we find that the books of accounts are not maintained according to the correct method in which it should have been done, even though auditors have signed.
Correct. Next, sir. Sir, here I'm reading that particular decision of the Supreme Court, sir, with regard to Exim Bank. The Exim Bank has 1 minute, sir. The Exim Bank granted a dollar term loan for JENV, Netherlands, under the applicant's overseas investment finance program. The term loan was secured by the corporate guarantee given by JEPL, which further secured by JEKPL counter guarantee. Actually, JEKPL is a given counter guarantee. Counter guarantee. And counter guarantee, and later on a counter guarantee of a corporate guarantee. Now 3 people are there. JENV, JEPL, and JEKPL are the part of the jubilant group. Exim Bank claimed as a financial creditor was rejected by the RP, resolution profession, as a financial creditor without calling for any explanation. Adjudicating also affirmed the RP's decision. Respondent avoid as per the section 5(8)(h). Counter indemnity obligation is respect to the guarantee should be have given issued by the bank and financial institution. Exim Bank is neither regulated by RBI nor governed by the license of the Banking Regulation Act. Further, JEKPL liability would arise only when the JEPL is defaulted on its corporate guarantee obligation on the valid invocation of the limited NCLT. Both JEPL and JEKPL is jointly and severally liable to the Exim Bank and held the counter guarantee obligation failing within the ambit of the section 5(8) subsection and the clause H. So this is a Exim Bank. That Exim Bank finally the adjudicating authority rejecting the claim of Exim Bank and financial creditors set aside. And the adjudicating authority in the RB directed the treat the Exim Bank as a member of COC, reconsider the resolution plans. Sir, here actually Exim Bank has given one term loan. For that, two companies are given. One company is given guarantee and JEKPL is given counter guarantee. And the JEPL is having the problem. And the Exim Bank also, whatever the counter guarantee is there, that a counter guarantee to be paid by JEKPL. And the resolution professional not admitted the claim because of it is not a scheduled bank. Second one is this is only counter guarantee like that. Then they have not admitted in COC, that committee of creditors, and no voting right, nothing is there. After that, the Supreme Court given the judgment, particularly they are coextensive. Both the companies are coextensive. If JEKPL is not
Mother Gopalji, kindly mute. We are in important session. Administrator, kindly help.
Sir, I have muted.
So later on, the Supreme Court admitted the claim and the resolution plans are to be revised. Resolution plans, whatever the resolution plans approved by the NCLT, that is to be revisited and reapproval by taking into consideration of Exim Bank claim, as the Exim Bank has given term loan for JEKPL given a counter guarantee, that is it is a contingent liability. It is a contingent liability.
Sir, one additional, sir, we had a similar circumstance where a group company, one of the company had given the guarantee, corporate guarantee to the banker for the another group companies, but these group companies have got inter liability. So similar circumstances arise, and actually what has happened, this claim to be admitted, but also a counter claim to be made on the company which has enjoyed the benefit fruits of this. If that has not gone into the CARP also, they have to remedy this and pay to this company. Identical situation we came across in live situation. And so while accepting this liability, we have made a counterclaim on the company which has enjoyed the benefit of this money. And so obviously that there is out of this only one end has got reflected for the benefit of the listeners. There is another end to this. While accepting this liability, that corresponding proceedings have to happen on the party which has enjoyed the fruits of it, and those company, even if they are in the CARP, should be registered as the claim into their company, or if they are not in CARP, those assets should be taken into consideration, which if they are still continuing, in this case, since he is told it's for the machinery, can be attached and it can be recovered through disposing of those assets by the RP. Thank you, sir.
Okay. Sir, here finally, I'm giving some conclusion, particularly the today's discussion. Contingent liabilities are also pays lot of attention by the IRP or RP. So the contingent liabilities are different kinds are there. All kinds are to be get the full information from the respective departments, particularly the bank guarantees or letter of credit are available with the finance department, and any shoot filed or copyrights or whatever warranties and other things are there, that is available with the law department. These are also the stage of the case, the stage of the guarantees, and that is to be properly jotted down. Second one is whatever the letter of credit is there or the bank guarantees is there, definitely company property mortgage to the bank by way of equitable mortgage. That particulars you have to get it. Second one is whenever the guarantees are given, the margin monies are also stipulated by the banks, that is paid by the company. That is also to be jotted down. Thereby, one conclusion or for each and every particular contingent liability, in-depth study is very much required. So once all these things are going to be crystallized shortly, this information is also to be put into the information memoranda by the IRP or RP. Why? Because if at all it is not mentioned, later on some consequences or problems will be arise to the prospective resolution applicants. To avoid that one and a clean slate theory, then we should not give any inconvenience to the prospective resolution applicants. Once the baby is transferred to other person, you should carefully handle that baby and hand over the same without any problems later on. Otherwise, whatever we are thinking, if the IBC preamble clearly states, particularly we are talking about going concern. If the company is handed over to other person as a going concern, lot of benefits are there to the economy as well as to the particular company management also. Why? Because once it is a going concern, the GDP growth will increase, unemployment problem will decrease. So many positive points are there. If at all, after taking over the company, if at all still he is facing with the litigation or legal battle, the legal problems, then automatically his concentration on the company will lack. So to take the company, to take over the company, the relevant facts, true and fair position of the company, including contingent liabilities also to be mentioned in the information memoranda and give it to him. Then only he will decide whether to take that company, and he will also frame his mind. In future, these litigations will come, these problems will come. I have to ready to attack. That type of confidence also, it is inbuilt in him. If at all we are not providing that information, like in certain cases, then automatically it will be a problem. Revisit the resolution plans, and a lot of the legal hurdles are there. To avoid all these things, all liabilities are properly assessed, properly verified, properly recorded, and any hidden or unnoticed liabilities are there, properly jotted down and informed to the prospective resolution applicants. Thereby, they will be happy. The CIRP process, COC will happy, as well as the resolution profession also happy. This is a qualitative approach. Why the contingent liabilities? If you take the contingent liabilities cases, deciding cases or judicial pronouncements, nearly 40 to 50 cases are there, particularly on the contingent liabilities. So to avoid that legal battle, all these things, if RP or IRP is taken care of at the time of a CIRP, then this type of situations will not arise to the prospective applicants. Am I correct or not, sir? Tell me, sir. Narayan sir. Hello. Hello. Sir.
Tell me.
Whatever I told, whether it is that is correct or not, precautionary measures, particularly the IRP or RP, to be taken, lot of precautionary measures while framing the list of claimants, including the contingent. Special attention is to be given to the contingent liabilities. Is it correct or not?
Yeah, it's absolutely correct, sir. Contingent liability is an important part, and it's not only arising out of the only banking transaction. The non-banking transactions are very huge, like what you have explained.
Correct.
It's only very small tidbits. We have got cases where, like the agreements and like under the Contract Act, because obviously sale of goods or anything else has got no meaning as far as we are concerned. The Contract Act is the only act which has got the meaning. So any contractual obligations which can give a contingent result are all, and very importantly, we are getting cases mostly on the third party claims, and also the claims on the Sale of Goods Act. There are the transfer of property is not being properly understood by most of the practicing professional even, and the transfer of property and the related cases, and the vast amount of the transactional obligations or in fact becoming contingent on various occasions, and the decisions are all been very tricky. So the position of the RP is really in a very tough spot. We can't go to the most of the people. I don't know how many are handling the cases. We cannot take go back to the NCLT, though we are talking about going to LCLT, going to NCLT. Even the 19.2 is taking nightmarish time, and that's been now on certain of the cases at least they have to give the verdict. The even after that the time of resolution plan, some of the the important buffet transactions also are pending before the NCLT. It's a very tricky situation for the RPs today.
Correct. Sir, here one question. Whether demand notice issued by tax department before or after initiation of CARP process, but not accepted by the CD, rather appealed against the same with appropriate, should be treated as a provisional claim or contingent. It is not a contingent liability, first of all. It is not a contingent liability, because here they have issued a demand notice. For that, the CARP, particularly in the CARP process, whatever the claims are there, whether it is a GST or income tax, all ought to be admitted. That a demand notice they have given after initiation of CARP, but not accepted by the CD, that is immaterial. Once the CARP process is started, the role of the CD is not there. The role of the COC, the role of the IRP or RP is there. So
yes, sir. It is not accepted by the IRP.
It is not accepted by the IRP.
Yes.
But you have mentioned not accepted by CD.
Sorry, I forgot to.
Okay, that not accepted by the CD. Sorry, if you see the judicial pronouncements, in the judicial pronouncements also, particularly ESI or tax authorities, that is to be accepted by the IRP or RP.
Okay.
They should not reject. It is not a contingent liability. Sorry, income tax department on the particular income only
But
they will arrive.
currently, little bit. Currently, it is under adjudication. That means CD has already appealed against the same.
Okay,
So there is no final decision.
Sir, we should not talk about the CD, sir. We should talk about the RP now. The CD is being replaced by the RP. The corporate debtor, whoever that the prior management has got no role. The RP has to freshly take an assessment just because is it a right, like the case which was under the which was made appeal, or is it like appeal made for just taking the time off? He has to take those decisions and he has to take appropriate authority. These cases can all be moved. Every cases pending anywhere in the court will have to be moved to the NCLT. So probably if any practical such situation comes, all those cases have to be decided, and the RP has to take the pains to go sit with the income tax authorities to take any decision. And if the decision is wrong as per the RP, he should go for the appeal, and it should be crystallized before coming to this decision. I think that this question doesn't arise whether the CD accepted, doesn't accept, has not accepted, has got no meaning after it comes to the CRP of the liquidation process.
He rectified that.
He has stepped into that.
Okay.
But here, sir, finally concluded. Contingent liabilities law department is the correct department of the corporate. The CD law department, other than financial, particularly the guarantees and the letter of credit, the suits filed against the company with regard to various this one, particularly the warranties or guarantees or against the company. So many are there. Land disputes and other things are also there. Not only this one. Today, labor code also, Workmen Compensation Act, so many claims are also arising. So these claims are available, the information is available, none other than the law department or the production department, or if you interact with the union or employees also, they will provide the full information. All these things are to be mentioned in the information memoranda. Okay, information memoranda is a marketing document. It doesn't mean only rosy pictures. The gray areas are also to be mentioned in the information memoranda. Then only the particular the resolution applicant, whether to take or not to take, or whether to file the resolution plan or not plan, then he will decide based on the overall view or overall picture or overall financial affairs of the company. So this is in brief about today's discussion, sir. And number of cases are increasing, particularly on contingent liabilities. To minimize that one, we have to pay special attention on the contingent liabilities and include that information in the information memoranda, and whether all these things are responded by the resolution applicant also not, that is to be verified by COC as well as the resolution profession. This is in brief about today's discussion. Thank you very much for your patience listening for the last 4 hours.
Thank you so much, sir. Sir, one small addition. On the case, if that the adjudicate, the income tax authorities have not finalized until the resolution, if the resolution plan comes up fast, then obviously it should be provided as a contingent liability. If RP believes that the case is weak against the income tax department, and even if he has got the slightest doubt, it is cat on the wall, he should provide for the liability in the resolution plan, sir.
Okay, okay, sir. Okay, sir. Correct.
All right.
So,
Thank you.
Thank you very much, madam, for giving an opportunity to discuss about this contingent liabilities.
Thank you, sir. Thank you so much for being a part of the session today and clearing so many doubts of the participants. So thank you so much for sharing your learnings with everyone. And thanks to all the participants as well.
Thank you very much, man. Good night. Good night.
Thank you.
Thank you.